ICT traders seem to overcomplicate everything, and I honestly can't put into words how excited I am to share this with you today. Now, some of you got access to this a couple of months ago when I released my free course. Now I'm dropping it for you guys on YouTube. Years of work and years of learning, years of refining a model went into this. So I hope you find it valuable, and it's the exact blueprint that took me from zero to over $10,000 a month with trading. If you follow this properly and you take notes on this and you actually listen, then apply the things I'm saying in this full free course, you will also go from 0 to 10k a month if you apply it properly. Now, like I say, it took me a while to do this, so if you find value in this, the best thing you can do to support me is to subscribe. A lot of you watch my videos and aren't yet subscribed, so that's all I ask for, and I ask for you to drop a like if you want more of this content going into 2026. I truly believe I put a lot of effort into this, and I truly believe that if you listen properly, it will change your trading for completely free. All I ask for is a like from you guys. Now, what do you say? Let's not waste any time and dive straight into the full free course. And the very first episode is going to be about daily bias. So let's load up the charts here, right? If we go over to NASDAQ, because NASDAQ has been really clean recently. When I say daily bias, you guys must understand first, I am not only talking about daily candles. Mainly, when I speak about daily bias, I'm speaking about the weekly candle. Listen to this very carefully, what I'm about to say. If you can predict the very next weekly candle, you have bias. That is all there is to bias. You are just trying to predict the very next weekly candle. And that's what so many people get wrong about bias and about trading in general. You are only trying to predict the next weekly candle. So how do we do that? Well, first of all, you want to identify order flow. Are we trading higher, and are we respecting down close candles in an uptrend? Or are we trading lower and respecting up close candles in a downtrend? Now, once you've established that, which quite clearly on the NASDAQ demonstration on your screen, you can quite clearly see we're respecting down close candles. Every time we trade into one, we trade away from it as well. That is bullish order flow. Now, what else do we look at? PD arrays. You want a discount array. What is also a discount array? Old lows. So every time we trade into old lows in a bullish market, we want to see rejection from there, and then we want to see the next candle expand. So let me ask you something. On this example, if we trade into an old low here, previous week low, and a down close candle here, is this candle not predictable? Of course it is. It's very predictable because we're in bullish order flow. We've traded below a previous candle low into a key level. Those three components of price allow us to predict the next weekly candle's expansion. Then it expands. And that is how simply you align yourself with order flow. You are predicting the very next weekly candle. Now let me ask you something. If we close bearish this week down here below previous week low, is it not likely that we come here? Would this logically not make sense? Why? Let's explain this and let's break it down, because you're predicting the next weekly candle. So in this scenario, let's say this candle, if I draw it out in time, closes bearish, and we have a strong close here, right? Let's pretend this is the weekly candle. We close down here where this blue box ends. Now, what can we say has happened here? Now, after all this, you want to incorporate what levels have been respected and what levels have been disrespected. Now, if you look at this, what did I just tell you? Down close candles in a bullish market support price higher. You can see mean threshold of this should be a sensitive area. So if we label that orange, look how the weekly candle hypothetically has closed here below mean threshold, and look now, what you want to identify is, do we have clean liquidity? Fair value gap here. That low is a low. Low, 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 low. So we have 4 relative equal lows here and a day and a weekly fair value gap below us. Is that not smooth liquidity? Let me ask you something. If you have 4 lows in a row just above a key level, is that not a smooth draw in liquidity? Absolutely it is. Okay, so when we close bearish now, you need to consider the likelihood of us trading lower the next weekly candle. Simple as that. Now, I know a lot of you will have watched the 2022 mentorship. Everyone says it's terrible. Everyone says it doesn't work. What everyone misses is ICT literally says in the second episode, I know this because I studied, I put years of effort into this, years upon years upon years of effort into this before I came profitable. I know this. He says in the second episode, you need to be trading this in the direction of the weekly candle. Why do you think he's on the weekly chart? On the second episode. Why do you think? Because he's predicting the weekly candle. This is worth thousands of dollars. This information I'm giving you for absolutely free is worth thousands of dollars. Really consider that when you're listening to the rest of this course. This is worth thousands. Seriously, thousands in value for absolutely free. In the second episode, he says, we need to trade this in the direction of the weekly candle. This is why I've got a whole section on the higher time frame. When I say higher time frame, pretty much the weekly candle. Now, you want to engage in the monthly candle as well. We're always engaging in a monthly candle, right? And take a look at this month so far. Now, it is, at the time of recording this, the 29th of August, 2025. We have taken previous month high, shown some rejection from it. Now, I really want to see in the next 2 days where this monthly candle closes. Because if this monthly candle closes bearish now, this monthly for value gap becomes a target for me. Now, targets are two things. Targets are places we look for a trade from. Okay, so when we trade back down here, we can look to buy. Or targets are also a place where we look to offload our positions. Now, if I think this is a target, I can sell down to here as well. That's what everyone gets wrong. You can sell down to here, and that is how you catch more trades as well. Like a magic trick, isn't it? Right. This is all logic, guys. This is all logic. And I can tell you this because I've been in the markets. I've made money in these markets. I consistently make money in these markets. And I've got multiple students, multiple testimonials of people saying I've changed their trading. That is not random. That comes from giving value. And I'm going to have 50 more testimonials after this course of people saying I changed their trading, I made them profitable. Just listen. If you can't predict the next weekly candle, don't trade. Don't trade. If you're not profitable yet, do not trade. You can find scalps if you don't have a bias on the weekly time frame. You can. But if you are not profitable, there's no way in hell you should be doing that. No way. I can do that. Some of my one-to-one students can do that. You guys should not do that, especially if you're not profitable yet. So it's really important. You have to trade in the direction of the weekly candle. If you cannot predict that weekly candle, you don't have a trade. It's as simple as that. Now, again, if we close bearish here, not even below this low, if we just show some signs of rejection, because again, this is a down close candle in a bullish market. So it should do what? Should support price higher, not only the opening price, but a mean threshold here. If we trade through it, then it's disrespected. I always tell people I've got an if this, then that approach to buyers. So let's say we came down into here. If we respect it, then I think we continue with order flow and we go higher. If we disrespect it, then I think where are the liquidity? Where's the liquidity? If it's below here, then we take trades down to this point. And at this point, we sit back and reassess. Let the market prove itself to you. Let it show you that it either wants to go higher or lower, trade through this, maybe redistribute on the other side for these lows. But it needs to prove itself to you when you get to key levels. That's what's really important. If this, then that. If we close like this, then I'd say we're probably respecting this opening price here. Because we've closed above it once, closed above it twice. That's a respect of opening price. Now, here's another gem. If this candle closes like this, and I don't think it will because we have Nvidia earnings, it should be volatile. We have an inside candle because this candle didn't take out this candle's high or this candle's low. Inside candles lead to bigger candles. Why is that? What's the general logic behind that? Well, if you think about the idea that small ranges lead to large ranges and large ranges lead to small ranges, this would make complete sense why I would predict the next candle to be bullish or bearish. Whichever I side with, the next candle I'm predicting to be strong in either direction. A really big candle though. Why? Because this is a small range. So this is doing what? This is accumulating positions to distribute later on. Because it's an inside candle. We didn't take previous candle high, nor previous candle low. So what does this look like on a lower time frame? It simply looks like this. On a lower time frame, this looks like this. And then the next candle looks like what? Something like that. So this area here is this candle on a lower time frame. This drop down is this candle on a lower time frame. This is accumulating positions to distribute in what? The next candle. That's why I see it say you need to focus on one candle. So this is this on a lower time frame. It's accumulating positions to distribute when? The next candle. Very, very simple stuff. So all I'm trying to do in my trading, all I'm ever trying to do is predict the next weekly candle. Is it going to go higher with certainty, or is it going to go lower with certainty? Or is it going to do absolutely nothing? If it's going to do nothing, I do not engage, or I look for scalps. If you are not profitable, you should not look for scalps. Simple. You should only trade in the direction of the weekly candles expansion. Again, ICT said this for a reason. Everyone skips over this. I spent years listening to his words carefully so I can give this to you guys for free, so I can break it down in a simple manner without the long-winded rants. Just value. So this is the first introductory video to the free course. I hope you guys found it valuable. Let me know if you did. And again, this is the start of a very, very good journey for you guys. This will change your trading around, and I can't wait to share it with you. What is up, everybody, and welcome to episode 2 of the free course module. In this module, we are going to be speaking about how to align yourself. Now that we understand where the weekly candle is going, how to align yourself with the weekly candle's expansion. Let's not waste any time and let's get straight into this. You must learn to align yourself with the weekly candle. You need to understand where that candle is going, but then how do we involve ourselves in that candle? Now, if you take a look, let's look at the weekly time frame on NASDAQ, because a lot of this is based around NASDAQ. Now, you can trade dollar with this. It's just dollar right now is really poor price action, all working inside this range right now. Now, you have to be able to, first of all, predict the weekly candle's expansion. That is priority number 1. You have to be able to predict that. If you cannot predict that, low probability. Now, how do we align ourselves with an expansion? So in the last example, we went over this weekly candle here. To align yourself with a weekly candle's expansion, and let's write this down. To align yourself with that expansion, how do we do it? Big question marks. How do we align ourselves with that expansion? Ran. Okay. PXL and PXH ran. What does that mean? What's PXL and what is PXH? PXL is previous something low. PXH is previous something high. Okay? In reference to the weekly candle, what do you think we want to see ran in order for us to expand and get on side with that expansion? This becomes either, okay, and this is previous day low ran or previous day high ran, or a 4-hour low / high, okay? This is what we want to see to engage with a weekly candle's expansion. And write this down, guys. Take notes on this. I'm giving all of this, which is worth thousands of dollars because it's made me multiple thousands of dollars. This is for free. So please write down what exactly I'm saying. How we engage with a weekly candle's expansion is we look for a previous day low or a previous day high ran, or a 4-hour low or high, and we'll get into the second option, but mainly you want to see this first option. This is how we engage with the weekly candle's expansion. Now take a look. Remember, this was the start of the weekly candle. Monday starts here. Let's delineate this weekly expansion here, right? This is your weekly candle. If I drag this down so we keep an mind on it. Look at this. What is this? A previous day low. Okay, so when we've got an expansion candle, how we engage with said expansion candle is previous day lows and previous day highs. Why is that? Because, okay, it's all well and good knowing that. It's all well and good knowing why, what we need to do. But the key is to understand why we need to do it. What's the logic behind this? People at the start of the week are getting tricked in below this low. Not only are sellers getting tricked in, but buyers are getting stopped out early before the expansion happens. So this provides what? What does this provide for us to go higher? Liquidity. Liquidity is provided here to go higher. And here's a little gem. If this signature in price, meaning previous day low or previous day high ran, not on just Monday, it can happen on Tuesday, Wednesday, Thursday, it doesn't matter, as long as the weekly candle is actually going to expand. If this happens inside of sell side liquidity, that is extra confirmation and extra confluence to add to your probabilities. So low, 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 3 equal lows, relatively equal lows. Where does this previous day low ran happen? Inside of this sell side liquidity. That's where it happens. So how do we engage with this? And why did I say 4-hour lows? Well, if you take a look at every 4-hour low that gets engaged, we expand away from. Because that is how you actually enter on the weekly candles expansion. Now, guys, this course is heavy. This course is absolutely everything. No gatekeeping at all, apart from a few things, which is reserved for my one-to-one upper class mentorship. I cannot give all of that away, but this stuff is everything I use. This is gems all put together. You will never need any more education if you watch this in its entirety and actually take notes. How do we engage with this weekly candles expansion? Well, previous day low ran here, right? So let's label this so we do not forget it. Previous day low. If I can actually type. Bottom left, right? Previous day low ran. This is our sell side liquidity for that. What is this? Accumulation, manipulation, distribution, right? But we must align ourselves with that distribution. How do we align ourselves now that we've had the framework for the weekly candle to expand? How do we get on side with this? I'll show you exactly how. Why did I mention 4-hour lows? Well, because 4-hour lows in the weekly candle are really key. Because every 4-hour low that we see, almost every single one we reject away from. Take a look. Is that random? Absolutely not. That is not random. That is me knowing the ins and outs of the algorithm and what it is going to do at what time. Every single low on the 4-hour here, we run away from. Okay? Every single one that gets taken, we run away from. Now, guys, what you must understand is we're focused on the ones that happen at key times. We're focused on the ones that happen at 10 a.m. or 6 a.m. if you're trading the NASDAQ. What I just gave you is absolutely unbelievable that I'm giving that away for free, because that is absolutely everything I use to scalp the NASDAQ. Now, you may ask, how do I scalp it now? You fractalize this idea. So if you're not predicting the weekly candles expansion, what are you predicting? You can predict the 1-hour candles expansion. Which 1-hour candle? The 10 a.m. candles expansion. If you are predicting that the 1-hour 10 a.m. candle will expand in said direction, whichever direction that is, you can get on side with what? 15-minute lows being ran or 5-minute lows being ran. That is absolute gems right there. That is a gem. Seriously, note that down. Please note that down. How we engage with a 1-hour candle expansion, 10 a.m.'s candle, is 5-minute lows being ran, then rejection from that. And you can fractalize the idea even further down. This is the best education on the internet. Now, again, predicting the weekly candle is easy. You guys know about buyers, and you should know how I approach buyers. It's a process of, if this gets respected, then I do this. If this gets disrespected, then I do this. And I'm looking for low-hanging fruit targets. But how we engage with those expansions is key. How we engage with that is very key, because that tells us, that actually gets us into the trade. And obviously that's where the money is made. But you must be able to predict the candles, right? And I can show you multiple examples of this weekly candle happening. Okay, where's Monday here? Monday to Friday, right? This is the 4th of August to the 8th of August. This week here, okay, we have Monday, Tuesday, Wednesday, Thursday, Friday. When do we expand, and from what point? At what point are we allowed to expand? When we take a previous day low. Look at that. Must be random, right? Must be completely random. I don't know what I'm talking about. And boom, it happens almost every week. That is how you align yourself with the distribution. Now, if you look at the 4-hour time frame, low ran, low ran, low ran into a gap, move away, low ran, expand. Okay? Now, this will appear all the time. You will never need anything else after listening to this. And again, guys, how do we align ourselves with this distribution now? Every time we run these lows out, how do we align ourselves with this distribution? How does that work? Well, you fractalize this idea and you're only engaging at key times. Meaning, are we engaging at the 10 p.m. 4-hour candle? Absolutely not. We're engaging at the 6 a.m., the 10 a.m. and the 2 p.m. candle. The 2 p.m. because if 10 a.m. and 6 a.m. does nothing, 2 p.m. will expand. Another gem. If you're watching this like Netflix, these are the sort of things you will skip over and not take note of. 6 a.m., 10 a.m., if they do nothing, like in this case, they expanded here, but if they do nothing, then 2 p.m. will be the expansion. Okay? That is simple, and that is logic. Look here, 10 a.m., small range, 2 p.m., bigger range, right? And then vice versa, it happens all the time. That is how you engage with the weekly candles expansion. And really this video is on engaging with any candles expansion, because I just gave you the source on how to scalp anything, how to trade anything on the lower time frame. Is you're just talking about predicting a candles expansion just on a lower time frame. And this is the stuff, I would usually say this is the stuff that you paid for, but it's absolutely free. Okay? Now, use this on the 4-hour candle, on the 1-hour candle, on the daily candle, on the weekly candle. It applies to absolutely everything because it's based around logic and narrative. This is exactly how I engage with these markets all the time and how I do it so consistently. Because let's say you were predicting a daily candles expansion. How would you align yourself with that daily candle? How is that possible? How would we do that? I'll show you exactly how we would do that. Okay? If we move all of this to midnight New York, what are you looking for? Previous hourly highs ran. Take a look. Previous hourly high ran there, drops. Okay? Previous hourly high ran, drops. And this is exactly what we look for every single time. You can even go on a 4-hour and it's just straight expansion after running this high out. So you're always looking for, what is it again? Let's recap. Prior XH or prior X low. The X is there because it depends what candle you're trading. That's why the X is there, because it depends what candle's expansion you're trading. Because again, all you are trying to do is predict the next candle. You're predicting the next daily candle here to be bearish, and that is how we engage with it. That's all you're doing. Right here. All you're doing is right here. Note all of this down. I hope that was useful, and I'll see you guys in the next module and the next episode. What is going on, everyone? I hope you are all doing well. Welcome to episode 3 of the free course. Today we're going to be talking about 20-day alignment, meaning you want to try align yourself with the 20-day IPTA data look back. And if you don't know what it is, we'll be diving into what it exactly is. But first, I just want to explain a bit about how it works and how we actually use it to our advantage. Now, the 20-day look back is the day before you're trading. Go back 20 days, count back 20 daily candles, and that is your premium and discount, the highest high and the lowest low. They are also your key premium and discount arrays. Now, this is the absolute key to daily and weekly buyers as well. This is what people don't teach. This is key to daily and weekly buyers. Why is that? Well, it's because the PD arrays that we see in this 20-day look back are key for us to use our if this, then that approach. So you guys know I approach buyers through a lens of if we do this, then we should do that as well. Since I approach it through that lens, the key PD arrays I'm really looking at are the ones in the last 20 days and how we react to those ones in the last 20 days. So let's not waste any time. Let's get into some charting. So let's go to the daily time frame. And you want to think about the last 20 days. So count back 20 bars. I like to hold shift and then just drag it across 20 bars. And then the highest high and the lowest low is your premium and your discount. So in this price leg, this is your discount, this is your premium. How we react, now go back, 10 seconds or so. I said how we react to these price levels in the 20-day look back is how I determine bias. What do I mean? Well, perfect examples are here. These are always examples. Now, first of all, what are PD arrays? And this is going to be one of the best episodes in the course. What are PD arrays? FEGs, order blocks, old lows and old highs, which means swing highs, swing lows, and any old lows and highs, because it's important. It's all important because it's all in the last 20 days. Inverse FEGs, breaker blocks, whatever it might be, right? You get the point, you get the gist of it. Now, what you need to understand is how we react to each of these in the last 20 days is pretty much how I determine a bias and what I'm looking for. Now, partner that up with weekly profiles and you have a recipe for success. Now, so let's look at this. You want to pretty much identify all the premium and discount levels. Don't label them all because it will get confusing, but identify them in your head. Point them out to yourself. So, for example, this down close candle before this move higher, I would say it's bullish order block. And obviously it's in our last 20-day range. This, for clarity, is the last 20 days, right? So this is the last 20 trading days. That is a key level. That is a level we could see rejection from. That is a level that could be used for a target. All of those things. This is a bearish order block, right? This, in the last 20 days, in a premium, because again, discount premium, that's a bearish order block. That's also a level we could use as a target or as a rejection from. Excuse me. This fair value gap in the last 20 days in a premium, that's a level we could use as a target. This old low, previous day low here, that is a key level. This low here, this swing low right there, that is a key level because it's an old swing low inside of a discount of the last 20 trading days. And then one more example, this volume imbalance here. This one. Okay? Now, what have I just labeled? Let's recap. This low, this order block here, this order block here, and this volume imbalance. So 2 discount arrays, 2 premium arrays. You only want to focus on the discount and premium arrays in the last 20 days. And people think I'm joking when I say that. I'm absolutely not. You only want to focus on those. Why? Because it blocks out the noise. The algorithm is only referring to these levels. It is not yet referring to lows down here. If we break out of the range and as we drag the 20 days across, these start to become important, whatever. But right now it's working within this dealing range and it is only focused on this dealing range because it's in the last 20 days. These gaps here, this gap, for example, important because it's in the last 20 trading days. Where could we aim for? This order block, this volume imbalance. Do you see how I'm bringing in each array and how Each one has its own value. I'm assigning its value, its importance. Now, this is the PD array matrix, and this is how you actually determine bias. You determine bias through this because the algorithm is only focused on the last 20 trading days. This is what people don't tell you. My eyes are straining, so let me put my glasses on really quick. This is what people don't tell you, okay? People don't understand that the algorithm's only referring to the last 20 trading days. Now, you want to be doing the same because this is how you determine bias. Guys, stop looking back here. And why did I tell you you only want to be able to predict the next daily candle or the next weekly candle? But we're not focused back here. We don't need any of this. None of this is relevant for us to predict the next candle. Why would we need to look down here? We're focused in the last 20 trading days. So for example, today, I am bearish on NASDAQ. Do I think it's going to get down here? No, I'm not saying that. Not in one day. I'm bearish NASDAQ. Why? Well, because we're in a premium. This is a premium. Simple, right? Last 20 trading days, premium market. This is, as I mentioned to you guys, an order block. So we've come into this order block. Mean threshold eyeballing it is about there. We've hit that yesterday. Now take a look at our week. Monday, Tuesday, Wednesday, Thursday. What happens on an expansion week? Usually we trade back into the range on Friday. Thursday caps the weekly range. So isn't it reasonable for me to say, okay, we've hit a premium level in the last 20 days. Mean threshold of this order block. Mean threshold, for those of you, just 50%. So take the body, measure out 50%. It's about there. I'm eyeballing it, but it is about there. I've done it enough times. I can eyeball them. Thursday caps the weekly range. Friday's likely to trade back into it. Now, unfortunately, it has already made a massive move down during London, which I did miss because I focus on New York session. I do think we could get down here in New York irregardless. But I'm simply showing you guys how I'm building a story behind PD arrays. I'm building a story behind every key array that appears at a key time, not random ones. The last 20 days. This is what everyone gets wrong. Everyone on YouTube with YouTube level education is looking down here, trying to predict the next candles, the next 20 candles. Guys, forget the next 20 candles. And this is why I'm making this free course, because it's going to absolutely evolve your trading to a different level. This is a different level of education that people do not teach. Forget this. Guys, forget it. When we break out of this range, then we can worry about that. Or, like, for example, if we come down here, let me visualize everything, because a lot goes in my head that I can't really, that I just assume you guys know and understand, and I really need to realize I need to explain absolutely everything. If we break out of this range, then I can begin worrying about what's down here. Like, then I can look for that. But until we do that, I'm working within the last 20 trading bars. Okay, trading days, not days. Not Monday, Tuesday, Thursday, Friday, Saturday, Sunday. No, the last 20 trading days. Okay, you literally press shift and count back. The day before you want to be trading. So today's Friday, right? This is Friday's candle. The day before Friday, Thursday, count back 20 days from that point. As soon as you see 20 bars here, the highest high and the lowest low, take that range. That's your dealing range. And then you have key arrays in that range, right? This is like a different level of education. I want to drive it home because this is all you need. Stop listening to people on how to determine bias and they just say it's swing lows. Guys, please forget that. It's the reason swing highs and swing lows work on predicting the next candle is because of the 20-day the data ranges. The PD arrays in here, how we react to them tells you exactly what the next candle or the next candle after that is going to do. Because, for example, if Friday closes like this, I'm expecting Monday to look down here and trade into these lows. Why? Because we've come up into a premium, hit a premium key level, rejected from it, and now we have a swing high created. I don't want to see that swing high broken. Why? Because it also filled a daily fair value gap. And the one-to-one students will know what I'm talking about. That I classify that as a certain high that I don't want to give away here, but I classify it as a certain high. And that's all I'll say for now. But yeah, 20-day look back. And guys, this works for dollar. This works for absolutely everything. Now, I'm not sure if I mentioned this, but dollar is terrible right now. Don't even bother. There's absolutely nothing going on in this market. You don't want to trade this. I know everyone on financial Twitter seems to be trading FX and winning. That's what you'll see often. It's all noise. It's all nonsense. They don't know what they're talking about. They're risking in conditions that just are not optimal at all. So, yeah. Now, just to end, guys, the last 20 trading days are all you need for bias. The reason I say I'm only trying to predict the next daily or really the next candle, right, is because I don't need to be worried about what price is going to do 5 candles in the future. That's not relevant to me. And I'm only focused on what the very next candle will do. And that's all you need to be focused on. That's why I say you only need the last 20 trading days. The last 20 trading days are more than enough for you to gather information and determine what the next candle is going to do. It's the whole reason I say it's the only thing you need. It really is the only thing you need. You don't need anything else. The last 20 trading days gives you absolutely everything you need to determine daily bias. And I see so many people mess up by being worried about the next 5 candles or the next 20 candles, whatever it might be. I see so many people mess up in that aspect when you don't need to. All you need is the last 20 trading days, all right? 20 trading days, not days. Use that information, use the arrays in that area. And I think, let me see, because on my Notion, I used to watch ICT 2021 mentorship, and I think it's some of the best information out there. I remember a specific episode he did on this, and again, no one's put in the same amount of effort that I put into this. So I particularly remember an episode where he spoke about the 20-day trading range, and he broke it down perfectly to say exactly what we need to do, right? Let me see if I can. Yeah, perfect. So he put, we have moved up into an optimal trade entry between the high and the low here. Go back and think about the 4 functions of price delivery: consolidation, expansion, retracement, reversal. And then he goes into how we're missing certain parts of that function. And we'll dive into that a bit more. But on his chart, he's only referring to the PD arrays in the last 20 days. Because that's all that's important. Nothing else is relevant to what he is trying to predict. Nothing else relevant. You don't need to worry about anything else. You're just thinking about the last 20 trading days because it provides you all the arrays the algorithm is referring to. Absolutely all of them. So you don't need to worry about anything else. And with that being said, I'll end the video here. I hope you did enjoy episode 3, and I'll catch you guys in the next module. What is going on, everybody? Welcome to episode 1 of the second module in this free course. Now, in today's module, we're going to be going over ranges and why they are important. Now, first of all, to understand why ranges are important, we need to define a range. Defining a range is simple, okay? And by the way, before I get started, ranges are absolutely key for my trading. Every single trade I take is because a range high or a range low has been taken. Understand that. You must understand that to be able to become profitable. Now, a range is simply defined by a impulse price swing in either direction. So on this example here, we have an impulse price swing lower. Anything working in between this high and this low is internal range liquidity. Until we take out either the buy side above this high or the sell side below this low, you are working within internal range liquidity. High probability trades, and listen carefully, high probability trades form on the extremities of the range. That's the buy side example here, buy side taken, distribution lower to the sell side of the same range. If I move to this example, you'll see this is the impulse swing high, the impulse swing low. This is your range, range high, range low. Anything, absolutely anything that happens inside of this high and this low is irrelevant to us if we have not taken the high or the low out. consolidation in here, internal range consolidation, take out the range low, external range has been engaged. Now high probability trades form to the opposing end of the range. Very simple, very straightforward. Watch that a few times. That is the 101s of ranges. Really quick. Just before that, you'll find ranges often happen into key levels. So for example, this range gets built up. This is pre-market. This is open, trades into a higher time frame key level and rallies away. Same example here. Okay, so they often form above or below key levels. Now, I use absolutely all the time, I use ranges, right? For example, a trade we took here. My one-to-one group took this on NASDAQ. This is NASDAQ, it's just the mini version, so NQ. We took this trade from this hourly fair value gap. I specifically said in the Discord, I want to see ES trade into this fair value gap here. And it did. Then trade lower. But why is that? Well, because I was bearish on the day. We filled a daily fair value gap. And then we displaced lower. Now, why did I want to see this fair value gap before lower? Well, a couple of things. And first, again, guys, what are we focused on? Well, you always need a range to trade in. So let's go on to the 15 minute. What is this? Range high. Okay. Range low. So we take one side of the range, we trade down and trade to the other side of the range. Right? Very simple, very mechanical approach to trading. Anything I do is inside of a range. And I want you guys to notice something on a fractal level. This is going to be one of the best videos I've ever made. And it's completely for free. Now, hourly chart, right? What is this on a lower time frame? We've got this higher time frame range, right? You all know about ranges. I'm teaching about ranges today. But what is this on a fractal level? Everything I do, and do not mistake this for me just saying words. It is very important. Everything I say is extremely important. Every trade I take is because of a range high or a range low. I do not trade without them. So on a 5 minute time frame, this continuation, what is this? Don't even need to speak. Don't even need to speak because you guys should be seeing it. So what did I just tell you a few minutes ago? And this is going to be an absolute game changer. Ranges often form into key levels. What is this? An hourly fair value gap, right? Why should this support price lower? Because we're in a daily premium up here. High to low, daily premium. We've created a long-term high, and this move lower is what? What is this? Displacement. That is the algorithm flashing to you. That is the algorithm flashing to you that it wants to go in a certain direction. If your bias is on side with that, then you've got a trade. Now, on a lower time frame, remember, I said this happens often into a key level. This gray area, remember, is that hourly key level. What is this on the other side? You might have heard me say this before. Down close candles on the buy side of the curve. Once traded through, any key level that forms in this area holds to support price lower, and then reverse everything I'm saying for a market maker buy model. Consolidation, accumulation, reaccumulation, smart money reversal, low risk sell. Distribution, the second level of redistribution. Speed and distance comes at this point. Why? It also lines up with this mitigation block. Notice how I'm always building a story. It's what I tell my one-to-one guys all the time. They're like, Loz, why did you take this trade? Loz, why did you have this bias? Because I built a story behind price with conviction, based on logic, based on repeating narrative-driven framework. That is what we do in this space. Anyway, on a lower time frame, what is this? Again, guys, I do not engage with price unless I have a range high to range low. Look at this. Very, very simple. Now, when does this get taken? Key time. Time, then price. Time, then price. Remember that hourly gap is there, so you have a key level. Now, range high, range low. Anything inside of this high to low is internal range liquidity, aka time distortion. Distortion by way of time. The algorithm is not focused on this price action. It is focused when we take either side of the liquidity. Why? Because it needs orders to pair with the other orders, the opposing orders. Now, range high, range low. Anything inside of it, irrelevant. Don't even bother with it. As soon as we take out this high, now I'm hunting. Now I'm waiting. Now I'm waiting for a setup. At what time? 9:30 onwards. Because we raid a 15-minute swing high. If you guys watch the YouTube videos, 15-minute swing high. Raid into it. And then break lower. Right? I want to speak about this some more now. Well, we raid the highs, displace lower. Entry at this point. Why this point? Because we trade into this down close candle as well. Now this was very hard to catch. Don't get it twisted. This was a very hard trade to catch. However, high, low, high, breakdown, mitigation block, order block here, up close candle before the drop down. We move into it and drop away. Small volume imbalance inside here, move into it, drop away. Fill a fair value gap into where? The range low? Yes. And you may be saying, okay, because we've grabbed liquidity under this low, aren't we meant to go higher? Under here, because sell side liquidity being grabbed, aren't we meant to go higher? No, absolutely not. Because the draw on liquidity is all the way down here. Because the draw on liquidity, the market is predetermined to go lower. So no, I'm not looking to buy down here. Because the draw on liquidity is down here for the day. Fair value gap lines up with the old low. That's when you see this happen. Trade into it and drop away aggressively. Trade into it, drop away aggressively. So everyone always says to me, Loz, how do I catch these trades that just trade into every order block, every fair value gap and move away? You trade index futures after 9:30 and after a range high to range low play has happened. Swing high, swing low. Anything in here is working inside of it. Take either side of that range, trade into with displacement. 9:30 takes a high, then we drop. Reaccumulation, drop. Reaccumulation, drop. Consolidate for the rest of the day. Why? Because the move's already happened and we've hit the draw on liquidity, meaning these equal lows. This episode was on ranges. It was more of a deep dive into my model and the model I'm going to give you guys. Now, there are a lot of gems in this video. Everything I do is because of a range, guys. Remember that. Every single thing I do is because of a range. What am I thinking going forward? I called this a really nice call. What am I thinking going forward? These lows as my long-term target. Now, do we drop straight from here? I'm leaning towards that. Absolutely. And I want to use this as like a proof of concept. I know what I'm talking about. I can say these things with confidence. I think we get down here in the coming weeks or the month. And then down here possibly. We'll see how we react to this low. If this, then that below here. But do we drop straight from here? I'm leaning towards that, yes. Or could we run up one more time, take some buy side liquidity above here, then drop? Yes. But I will be reacting to price because I have an if this, then that approach to buyers, and always that. Okay? I hope you found this episode valuable, and this module is a special one, guys. This is where the magic happens. This is the fun part. Okay? I cannot wait to see results you guys get with this whole course. I'm doing this absolutely for free because I want you guys to succeed. Now, my one-to-one students know exactly the framework I'm going to talk about next, and yeah, safe to say they're excited for you guys as well. Okay, they know what's coming. They know exactly what the next episode is on, and they are just as excited as I am to see it. Okay, I hope you found this video useful. Watch it over a few times. That will be necessary because it's a lot to take in. Ranges are a very key part of my trading. Just before I end the video, what is this? A range. It becomes important to us when we take either side of this range. This side of the range has been taken. We've now displaced lower. What's that? The algorithm flashing to you. What's this? A fill of that and displacement away. Okay. Anyway, I hope you find it valuable. I'll catch you guys in the next installment. What's good, everybody? Welcome to an episode on lower time frame ranges, how we use lower time frame ranges, and particularly why they are important. I'm taking you into my exact journal right here of a few, not all of them, there are plenty more than this, but a few examples of what the lower time frame should in general look like when you're trading this course and, you know, my concepts and ICT's concepts or whoever's, right? This is a general overview of what a trade should look like, okay? Now, London session, as we all know, is 2 to 5 a.m. Here, 5 a.m. So these are London session lows, right? I've labeled it AM session continuation purge. Because as we come down into here, I am bullish on the day. And guys, remember this. Anything I do is with the backing of a bias to my trades. So whether or not I show you the daily chart, I was bullish on these days. Very simple. I was bullish on these days. That's why I'm looking for longs, etc. Now, classically, what you'll see is accumulation, manipulation, distribution, of course. Now, AM session continuation purge, meaning the lows of late London session are being used to pair with these highs. Listen to what I just said. The lows from London session are being used to pair with these highs. So we are taking positions here and distributing them to willing sellers and buyers above these highs. That is simple. How do we get involved with that? Well, if you take a look, if we zoom in here, what will you notice about this? Low, high, lower low, higher high. So this is what? A breaker. Paired with what? A fair value gap. Meaning a lot of people come to me, is the unicorn model good? Is the unicorn model something I should trade? Is the unicorn model... Guys, the unicorn is not a model. It's an entry technique. Very simple. A model is framework that repeats. A model is what I'm giving you guys in this course. That's a model. An entry technique is just how you get on side with that model to make money. A breaker, or a unicorn, sorry, is a lower high, lower low, higher high, breaker block, paired with a fair value gap. And that's what we get there. So we get that. It's also, if you notice, a swing high broken to the upside with a V shape. Come back down into the fair value gap, trade away. Note down everything I'm saying. I don't want to have to make another free course, guys. Really think I don't want to make another one. You guys, this is enough. This is what I make money with trading. It's what my students make money with trading. My one-to-one guys make money with this trading. So listen up. Low, high, low, low, high, high, breaker, fair value gap, we move away. Come back down, OTE, low, too high. What is the logic here? Why can we still be buyers down here? Because we haven't taken out these highs up here. And what are these highs? Range low, range high. Range low. At this point, have we taken out the range high? No. So we're still bullish. And the daily drawn liquidity is up here. So you can be a buyer down here. OTE, order block, last down close candle before the move higher, gets traded through. Wick into, wick into, wick into. Look how sensitive the mean threshold is there. This is algorithmic price delivery. Look how sensitive the mean threshold is. We tap down into it. Look at the aggressive move away. Same thing as two more. And then we get distribution. Okay. Now, this was a trade I called out live to my group. They will vouch for this. Equal lows down here from 10 a.m. Okay, so a time then price. Discount premium. Now, why? You might be thinking, why this is a random time? Why are you trading at 2 p.m.? Well, AM session was choppy. So when AM session is choppy, and I'm sprinkling little gems in and out, right? AM session can be choppy. When it is choppy, look at PM session. We also had FOMC, which is a two-stage delivery, 2 p.m. and 2:30 p.m. 2 p.m. just takes out both sides of the market, buy side, sell side, moves higher, and then 2:30 we open up and trade above this high. Now, what I was looking for now is, where is the liquidity? Simple. Where's the liquidity? That's literally what I'm asking. Where is the most obvious liquidity? Is it buy side? Well, no, we've taken a lot of buy side. Or is it these lows? Is it sell side? Equal lows to be made jagged. 1, 2, 3, 4. Smooth lows. Okay. Then what? Same characteristics. High, lower low, breaker, and V-shape, right? Is this not V-shape? Change in state of delivery is the orange line on the 2-minute or the 3-minute chart. Come trade into it, trade away, distribute towards where the lows. Okay, it is over and over again the same repeating logic in the same framework. Same thing here, a bit of a choppier one. Range high, range low, time distortion. Take the low at a key time. Okay, hint, hint. Trade higher, very choppy one to be fair. And then fair value gap fills, runs away, fair value gap fills and runs away. This I didn't catch because it was too choppy for me. I didn't engage with it. But the logic is there. The same repeating framework is appearing over and over again. Do not question whether this appears. It appears multiple times a week, guys. Multiple times a week. Over and over again. You do not need to worry about this appearing. You will never need to watch another free course or another course. You will never have to pay someone for anything ever again. Okay? And that is logic. Here is a trade I took the other day. Yeah, 26th of August, you can see there. Now, this is what fair value gap. What did we teach in the last episode? Someone remind me, what did we teach in the last episode? Range, low, into a key level. This is a 15-minute fair value gap, okay? Take my word for it. You can go look at it yourself. This was only the other day. PM session, continuation purge. I'm sure you're noticing a theme here, okay? 11:30 lows, trade into when? 1:30 onwards. Key time. New 4-hour candle is when? 2 p.m. 2 p.m. open, lower, open, low, high, close. It's the same repeating logic. PM session lows, AM session lows, time distortion, trade into them, range low, range high. Where do we target? Range high. When does it start getting muddy? When we're at the range high. Okay. Order block here, down into it, move away. Propulsion block, down into it, move away. Fair value gap, second level of redistribution, move away. Clear the highs. This is just a projection. Don't really worry about these. I mean, if you're not profitable, I wouldn't bother with these. These are just price projections. You take the break in market structure to the low, project it out in time, and you get a general idea of where we are going. The focus I want you guys to look at is the low to the high here, right? It's the exact same thing I spoke about. Drop the low, trade higher, right to the highs. The exact same thing I spoke about over and over again. There's a reason I'm teaching this to you guys. Okay, there's a very good reason why I'm going over this in detail, and I'll show you guys exactly how to enter, because there are specific things you want to see to be able to enter. But again, I pose the question, why at this point was I trading PM session? Why? Because AM session was muddy. AM session was choppy. And what do we know about consolidations? What do they lead to? They lead to expansions. So if AM session's a consolidation, what do you think PM session's most likely to be? And then I assess 15-minute range low as well. And then I assess, is it worth it? V-shape. Notice a theme. Repeating theme here. V-shape. That's what you're looking for. If I don't get V-shape, I'm waiting. Okay, because it's displacement in the algorithm is coded to do that when it is meant to deliver price to a certain level. Very, very clean example. Okay, so that is ranges and some examples of the lower time frame, what the lower time frame will actually look like. Okay, we actually trade this inside my one-to-ones. You guys will start to trade this now. It is very important you guys look at range lows and range highs, and then pairing it with logical levels, and then we move away. You get involved with that market very easy. Okay, this can be your model. Make it your model. What's going on, everybody? Welcome to episode 5, if I'm not mistaken. Blending ranges and higher time frame key levels. Now, very important episode because obviously anything about ranges is important. And I want to use Bitcoin here as an example because I think Bitcoin goes lower. And there's a perfect example of how we use ranges into key levels. Now, if I maximize this screen, okay, let me make sure I'm also recording really quick. Perfect, right? Now, Bitcoin here, I think, on the weekly time frame, is predetermined to go lower. We're in a premium from this price leg and this price leg. In a premium, we took out this range high here, range low rest down here. So I think we'd come for the sell side below this low. There's a nice weekly fair value gap here as well. Now, what did we do on the new week open up? We opened up higher and hit a daily fair value gap, okay? Any daily fair value gap? No. One that lines up with a fair value gap on the other side. So what do we have when we anticipate this? Sorry, I misspoke. When we have a gap on one side, that's one single pass through and then a single pass down on the other side, you have and you expect institutional order flow entry drill. What does that mean? What is IO Fed or institutional order flow entry drill? It basically means you're expecting not a full fill of the gap here, not a half fill. You can get a half fill, but you're expecting a quick wick into it and then run away with speed and momentum the following candles. That goes for any time frame. That is a gem right there. Note it down, please. When you have a gap on one side, a single candle pass through. You can see 1 candle, 2 candle. This is a single pass through, 3 candle, right? This area, this grey box is not random. This grey box is inefficient delivery because the algorithm only delivered buy side through here. So when we delivered sell side here, this got delivered. This didn't, right? So extend this out in time. And then if it lines up with a gap on the other side, you can see 1 single candle pass through. We don't deliver buy side in this area here. You expect IO Fed, right? Now, onto the topic at hand, ranges. Remember, this is your daily IFVG, okay? Your daily IFVG, even FVG, sorry, it is FVG. This is your daily FVG, right? And what did I tell you about ranges? Well, I don't trade unless we have a range. I do not trade unless we have a range. Well, we have a dealing range here, right? Impulse swing high to low. Clearly in a premium now. But what also happened, right? That's a fair value gap, quite obviously. But what also rests above this? Look at that. A range high, range low. Range high taken into where? A random level? No. A key level. Premium, discount. FVG in the upper portion of that with a high just below it. That's why it's important. The high is the reason it is important. Now I want to see Bitcoin get lower down here today. But there's actual logic behind this sort of thing here, right? FVG in a premium, consolidation, and what is this? Accumulation, manipulation. Now I'm expecting distribution, okay? Because again, why can I expect that? Well, if you take a look at the daily time frame here, these are equal lows now. And how many times have I told you guys, you want to be looking for levels that are so obvious to you, you almost ask, why should it not draw here? Look at all these lows. Now, look at these lows down here. 1, 2, 3, 4, 5, 6, all relatively equal. This liquidity down here has not been absorbed yet. It simply has not been absorbed yet. So, looking at these lows, would it not be logical for you then to assume it's probably going to reach down there? And guys, this is, excuse me, this is Daily Bias 101. But take a look. Again, you have a breaker here. High, low, higher, high. These are your breaker, right? I'm using the bodies here because they are the most sensitive levels. Come up, low risk sell, come up, first level distribution, come up, second level of redistribution. What did I tell you about the second level of redistribution? It is the quickest and most volatile, highest probability move in the entire market. Now you can fractalize this idea. Fractalize this idea onto the lower time frames, and we have a range. Everything comes down to a range. And look at the sheer momentum above this high. Is that random, do you think? No. It's logical price delivery. So that is an example of how we use ranges. There are multiple examples of this. You want to be focused on the ranges where there are key levels below it. Okay? You want to be focused on the ranges where there are key levels below it. If you went to NASDAQ on the 5-minute time frame, you would see multiple examples of this. Okay? For example here, right? 5-minute for value gap, probably a nice 15-minute gap under here. But why is this range low important here? And again, range low to range high. So if we zoom in there, 5-minute for value gap in a discount. London created it, so it's important. Low taken. Where does the buy side liquidity rest? Up here. FEG rallies into it, displaces away. Order block comes into it, displaces away. OTE, low to high, comes down and then rallies through the high, absorbing more liquidity. But why does every single PD array you'd be expecting to hold in this price leg, why does it hold? Because the logic's there. Because we're bullish on a daily time frame. because we've had a range low into a key level. Then we trade away, and every order block, every fair value gap, every single thing you want to see hold will hold for higher prices. And if it doesn't, all right, you take a loss. Like, this is part of being a trader. You're not going to be right all the time. My best models have a 70% win rate mechanically, right? Now, that win rate changes, of course, if you take a bad trade. So just think about that, guys, all right? I want you guys to really start thinking about ranges and what they actually provide and why they provide it. They provide liquidity, and I know most of you are tuned out by now. You're not listening. But those of you who are, they provide liquidity for buyers and sellers, but not just any buyers and sellers, institutional aware buyers and sellers. Very, very good stuff. Okay, this is market making 101. Now I'm going to keep an eye on Bitcoin today because, again, it's a nice example. I do think we go lower. It's a really nice example of a range low to range high play with a key level above it. Okay, they give us a perfect example for this to happen, right? Called beforehand, and you also saw me call NASDAQ, I'm pretty sure. So yeah, really good stuff. Use this over and over again, and I will catch you guys in the next installment. What is up, everybody? Welcome to another episode where today is a very important one. Okay, we are putting it all together. That's what I've titled this episode, putting it all together, because in this episode today, everything I've taught you, everything we've gone over in this little free course, we're putting it all together into one. Okay, I'm going to teach you exactly how I trade. Pretty much exactly how I trade. Okay, so let's not waste any time and let's get started here. Okay, and if you cannot, real quick, if you cannot make it to the end of this video, you're not going to make it. That's just how it is. You're probably not going to make it because your attention span needs to be focused. I'm giving you the blueprint I use to make money in these markets. So please, please listen up. So basically, how do I Loz trades? How do I trade? How do I tell all my students to trade? The very first thing, as always, I'm looking for a daily bias. So, for example, I'm building narrative, I'm building story, I'm building all of these things behind why price should do something, right? Well, here we've taken out buy side liquidity above this high. You guys know this. I've been over this example. And we've got multiple lows down here. These are all equal lows to me. I don't classify this as a liquidity sweep. I don't really care for it because guess what? This low is very similar to this low. This low is very similar to this low. This low is also similar to all of these. This is low resistance liquidity to me. The very first thing I'm asking is price going to rebalance liquidity or sorry, not rebalance liquidity, rebalance an imbalance, or is price obviously reaching for some liquidity? Now, what have we just done? Let me put my glasses on. What have we just done here? We have rebalanced this fair value gap here. So all of this sell side delivery got rebalanced with buy side delivery, right? And then I'm at that point asking, is it more likely we go for this high or for this low? Well, with the reaction here, this low now, definitely I can say it. But when we're inside that gap, what I have to consider is also the weekly range. And take a look at this, right? This week started here, Monday, Tuesday, Wednesday, Thursday. Thursday traded into this order block there. That's an important level. Thursday traded into that order block right there. Now, what I'm thinking at that point is, has Thursday capped the weekly range? Very possible that it has, because this is the last stop close candle that traded into this buy side liquidity. Then we moved away from it, also creating a fair value gap. So when we filled this gap, I'm now asking, where is the obvious liquidity? Is it more likely we go higher to take the buy side liquidity all above these highs, or lower to take the sell side liquidity? That's what I'm asking. And guys, this is all building a story behind price. That's what I'm doing right now. Filled the gap, and then Thursday, on an expansion week, okay, listen carefully. On an expansion week, Thursday usually caps the weekly range expansion. So if we've expanded higher, and it's an expansion week because Monday or Tuesday made the low of the week, if we've expanded higher into a key level now that I've just outlined, Thursday has most likely capped the weekly range. Now what I'm looking for, okay? Again, what did I tell you at the very start of this course? I'm trying to predict the very next candle, the very next candle. So if Thursday's done all that and we've built all that story and all that logic behind price, what is Friday likely to do? Is it likely to trade higher or lower? Lower. Now, now that we've established all of that, how do we, let me choose my words carefully because I do want to push this across in the right way. Now that we've established all of that story and that narrative of why we expect Friday's candle to go lower, how do we confirm it? How do we confirm that? Well, you're waiting for key times. So let's take a look at Friday's candle. Friday's candle, I'm going to use midnight open because that is true open. Opens up here, right? And what did I tell you about confirmation? Confirmation can be in the form of SMT, displacement, CISD, right? Those are the three main components you want to be using to confirm whether you're on side with a market. Now, if we take a look at this market, is price showing any of those three? Is price showing any of those three to us? And if you take a look at ES, right? SMT, you might not see it yet. You might not see it. But if you take a look at these highs here, right, on NQ, and then go back to ES, lower high there, lower high there, and higher high here. So remember, all of this that I'm doing now on the 1 hour time frame only matters because that daily candle is predictable. Guys, here is the real kicker. If the daily candle's not predictable, guess what I'm doing? Anything other than trading. I'm going out. I'm going to the gym. I'm spending time with loved ones. I'm doing something other than trading. When the daily candle's not predictable, whatever you do instead of gambling and trading is a good thing. Now, some of you take that to the very extremes, but you get what I'm saying. If the daily candle or the weekly candle is not predictable for that week or that day, guess what I'm doing? Not trading. Everyone asks me, how do I engage with that then? You don't. You do not. And it's that simple. That's why I'm really trying to drive this home to you guys. If you don't get that, guess what? You don't engage. It really is that simple. And this video is going to be a bit more of talking and all of that because we're putting it all together. This is part of putting it all together is me ranting about this because it's very important. Every new student I take on, and this isn't their fault. That's the craziest thing. This is not their fault. This is the fault of mentors not teaching how it should be taught or starting to teach before they've even really done it themselves. Every new student I take on always at, well, how do I engage today? Loz, why are you not active today? I'm not active today because I told you I cannot predict the daily candle. And again, I don't take it in spite. I don't berate them. It's not their fault. Like I've said many times, it's not their fault. They have never been taught better. Very few mentors I see on X, Instagram, YouTube, whatever it may be, teach this sort of thing. Some of them do, and shout out to them. But very few teach you that trading is 80% psychology. And I know it's so cliche. I get it. I've heard it too. I used to sigh at that. It is actually true. And like, that's the one thing that's actually true. You know those sayings that are so cliche, you almost don't want to believe it. But they're cliche for a reason. This is one of those sayings. Trading is 80% psychology. It's cliche for a reason because it's true. Okay? Psychology in the sense of waiting for a setup, waiting for that candle to become predictable. Now, there are ways you can trade without the daily candle being predictable. Because if I can predict a daily candle, I can predict a 4-hour candle. And if I can't predict a daily candle, I may be able to predict a 4-hour candle. That's scalping. But I don't want you guys doing that. If you're not yet profitable, which I'm assuming you're probably not if you're watching this. If you are, I mean, shout out to your work ethic, right? That's a different level of work ethic. You'll get far. And be honest with yourself. If you're not profitable, it's fine. But you have to be honest with yourself. If you're not profitable, it's cool, right? It's not a big deal. But if you're pretending to be profitable just to ease your mind, let's not do that. Let's be honest with ourselves. That's the first step to correcting any behavior. Now, I lost my train of thought. As you can tell, it's going to be a bit more talking because it's putting it all together. This is part of putting it all together. 4-hour candle. So I can scalp. I can trade based off of a 4-hour candle if I don't have a daily bias, right? I know there's a tweet out there which gets pulled up here and there every few months. If you treat the 4-hour time frame like your daily chart, you will a whole new world opens up to you. I'm pretty sure that's the tweet. And it's true. Now, let's speak about that in its entirety. So, this is our daily candle being predictable, right? This 6 a.m. candle, is this predictably going higher or going lower? Lower. I would say absolutely lower. Why? Because if you take a look at what we've done on 2 a.m.'s candle, we've confirmed the daily expansion with that 4-hour candle. And I might even change the title of this video to 4-hour candles and something so on. Maybe I'll make another one. But we have the liquidity down here that, remember, on the daily time frame, we want to see. Why do we want to see this low? Because it's the weekly candles low, but we've expanded and we've capped the weekly range. Remember that. So maybe not even this low. Maybe we've aimed for, and I was aiming for Thursday's low, previous day low, or this low. Okay, these are equal, so we can, well, relatively equal. We can look at these and say price might reach down here because, again, rewind, go to the start of the video. Remember why I was bearish. Remember why I was bearish on Friday. Again, real quick, because I forgot to include this. SMT on the daily time frame between ES and NQ. Big SMT, okay? So that's also a big confluence as to why I was bearish. Now, the 4-hour time frame. You need to, if you want to become profitable, you need to only trade when the daily candle is predictable and the 4-hour candle is predictable. If you only trade at those points on the Nasdaq, you will become profitable. You will make any money you want. You will get time and location freedom. I truly mean it. I've got time and location freedom. You see me in here all the time because I record content for whatever reason, right? But you will get time and location freedom and money freedom if you do this properly. If you trade when that 4-hour candle is predictable and that daily candle is predictable, you'll make all the money you ever need to make from these charts. And again, looking at the charts here, now you guys know I love 10 a.m. 4-hour candle. Why do I love that? Because 9:30 a.m.'s passed, which usually performs manipulation. Okay, so usually 9:30 a.m.'s passed, 10 a.m. will expand. Now, if you take a look at this 10 a.m. 4-hour candle, this right here, Friday 10 a.m. Now, remember, why are we bearish? All of those things are outlined on a daily time frame. Now, when this opens up, that orange line there is the open. Would you guys say it is predictably bearish? I'll just pose that question. I'll give you a few seconds. Would you say, I know it's in hindsight, would you say it's predictably going to be bearish candle rather than a bullish candle? Taking a look at this. Right? Pause the video. I would say absolutely, but outline why. Pause the video and outline why if you did not. Why? And I'll give you a bit of time. Turn my fan on real quick because it's hot in here. Okay, right. Why is it predictable? Why would I say this candle here is predictable? Because we haven't taken out sell side liquidity. So Wednesday's low is still intact. Remember that daily time frame. That's why I'm looking at Wednesday's low. Wednesday's low still intact. Okay. 6 a.m. 4-hour candle was very bearish. And what did it close below? These up close candles, right? So it's clearly bearish. Clearly bearish. Okay. Clearly a bearish market. And then we're confirmed. To me, we also haven't taken out this low here and this low. So these are like, that's a low resistance liquidity run signature. So real quick, low resistance liquidity, right? This is low resistance liquidity. So you will see a quick move down to these lows. Why? Because this is low resistance. This is a higher low. So meaning it's not hard for them to shoot down price quick. Now, if it looked like this, like that, instead, this is high resistance liquidity. So you'd see a bit more chop at these points and it'd take a lot longer, right? But it's not. It's like this. The same way this is higher than this. So it's low resistance liquidity. Meaning, what are we expecting? Speed. Okay? Price should not lag around. We want speed and momentum. 6 a.m. 4-hour candle found a discount. Found a relative premium. 6 a.m. 4-hour candle found a relative premium and then dropped. What do I mean when I say relative premium? Well, here's a gem and here's something you've never been taught. Every single candle has its own dynamic premium and discount. Why is that? Because it has an opening price. If you're bearish on a candle and that candle rallies above opening price, whether that's into a key level or not, that is a relative, a dynamic premium. Okay, because we're using the opening price. And I'll teach more on that. I will teach more on that. But that is a dynamic premium or discount. Because it's not going to reach all the way back up here to get a premium before dropping in the same day, is it? Why would it do that? How is it going to do that? So it seeks a relative, a dynamic premium or a dynamic discount. That is why it rallies up here and then drops. That's why you have an open, high, low, close. It's the same way this 4-hour candle, that orange line is the open. This orange line is the high, right? This area now, this whole area, if I remove the middle line, that whole area was seeking a relative premium. So the open to high is seeking a dynamic premium. And this is why people get confused because, well, if you're looking at this 4-hour candle, people will say, well, it's in a discount. And they'd look at that and say, how can you short that? ICT says never short in a discount. Wouldn't you wait for a rally up there, then drop? No. Why would it need to rally up here and then drop? It doesn't need to do that. People are trapped up here. We don't want to give them an opportunity to get out. What sense does that make? It doesn't. So price instead seeks a relative, a dynamic premium above the opening price here. This goes for the daily candle, midnight New York. This goes for the weekly candle, Sunday 5 p.m. New York. This goes for the 4-hour candle, the 1-hour candle, 15-minute candle. It's a dynamic premium and discount because when price is in an expansion, it is going to seek dynamic premium and discount. It's not going to seek your typical dealing ranges, premium and discount. Now that is something you've never been taught before. Open to high, then we drop into the lows. Very simple. So this 4 a.m. candle, this 4 hours, 10 a.m. candle is predictable, right? So if it's predictable, guess what? I can trade it. Drop to the 5-minute now because I don't mind the 5-minute, right? 10 a.m. Now, really, to be honest with you guys, you want to be involved at 9:30 here. That's just the truth, okay? But why can we say this up close candle? Now it's a small body, but why can we say this should probably hold for lower prices? Okay, why? Because we haven't taken the lows out yet. That's 10 a.m.'s open. So remember I told you it was going to seek a dynamic premium. This is a dynamic premium because it's the key level above the 10 a.m. opening. There you go. That is some sauce you've never been taught before. And I was debating whether or not to give that away, but I told you guys this is going to be my best work. I made that promise. And there you go. Now, really, to be honest, you want to be involved in this market at 9:30. I missed this trade because, unfortunately, there was no really clean price action on the lower time frames, and I did call this to a T. I should be pulling these call outs up, to be honest. Hang on. Figure out how to do that. I got my phone. Let me pull up this call out just so you guys see it. So I called this out. I didn't get involved with the market, unfortunately, but it was very choppy. Now, this is what I said in the main Discord here. I'm not sure if you guys can see that. I said, this is what I'm watching. And it was a rally above the highs there, right? And then we got the SMT with YM. SMT with YM we just left. And in the one-to-one Discord, I said I want to see it go from here. And you can see there, that's the SMT. And that's that price action right there on your screen. So, good call out. Good call out, but why did it work? Why, what's the logic here? Well, I'm predicting a daily candle bearish expansion. You guys should know that by now, not hard, right? Then we get accumulation when, well, to be honest, London expanded heavy. So London expanded away from this accumulation. We just dropped. Now I want to see dynamic opening prices. Well, 7 a.m. opens here. 8:30 opens here. Now, 8:30 provides manipulation into this high. So I've been teaching this for 2 years maybe. 830 and 930 both perform functions. Now, usually 930 performs manipulation, 830 just accumulates. That's usually what happens. In this case, we had a red folder at 830, so 830 manipulated. Guys, if we want to get involved with any trade at all, we always want to see manipulation, because that's the backbone of trading, right? You want to see manipulation. You want to see the other side of the market put into the market so you can distribute and trade against them. That's what 830 provides. So if 830 provides manipulation, what's 930 likely to do? Provide distribution, or at least some relative premium and then distribution. And that's exactly what happens, okay? 830 traded into what? Again, traded into what? Range high, range low. Okay, 830 traded, and we went over this example, but it's the same thing. We traded this live. These are live examples. 830 traded into the range high. Okay, the range low is down here, and the draw and liquidity is Wednesday's low. Why? Because we went over it in the daily chart, the daily time frame. Okay. Then ideally, the 1 minute looks a lot cleaner than this. If I'm honest with you guys, it was a bit choppy, but I did manage to get some position on at this point. No, this point here. Okay, so the order block here. Once we close below these 3 up close candles, that's when I sold, and nice drop off from there. Now, I sold this because we filled the 1 minute gap, so we shouldn't see price rally back above this high. We dropped, changed the state in delivery again. So we traded back into the order block here, traded away, ran above this high, stop run, drop, FEG drop, right? And then we really ran into these lows. And again, that's Wednesday's low. So all of this logic is the same repeating phenomenon. It's the same repeating thing over and over again, and I trade it over and over again. It's the same thing. I'm never switching it up because I don't need to, because this model actually works. When your model actually works, guess what? You can trade whatever you want. You can trade whatever you want because it actually works and it actually repeats. So we've been going now for 20 minutes. I want to speak a bit more about the opening times, the key times for Nasdaq. So key times for NQ. Okay, midnight New York, 8:30 New York, 9:30 and 10 a.m. and then 1:30 p.m. Okay, these are the key times for Nasdaq that I want you guys to focus on. Midnight open for opening price of the daily candle, 8:30 for manipulation or distribution or accumulation, 9:30 for manipulation or distribution depending on what 8:30 did, 10 a.m. for open, low, high close, or open, high, low close. Meaning the 10 a.m. 4-hour candle should provide you a new open, high, low close or a new open, low, high close, meaning you got another chance to get involved with this market in a dynamic premium and a dynamic discount. 1:30 p.m. is for when AM session consolidates. So if AM session consolidates and we don't do anything, we just accumulate positions, PM session should be good. And meaning if 9:30 doesn't do anything, if 10 a.m. doesn't do anything, if we just accumulate throughout the whole thing, 1:30 p.m. onwards is where you want to focus on. How do we use that? We use 1:30 as you would 9:30 or 8:30. The same. You just use it as an open. It's going to perform manipulation or distribution or accumulate. And then the new, I should really put this, 2 p.m. Why 2 p.m.? Because that's the new 4-hour candle for the PM session. So if 1:30 p.m. manipulates, 2 p.m. should provide what? Open, high, low close, open, low, high close, depending on whether you're bullish or bearish. And when you're done with this, I truly mean you will never need another video again. You will never need another thing again. All my guys in a one-to-one know all about this. This is pretty much what I use and the only thing I use, because guys, the truth is you don't need anything else. You just need repeating logic and framework. And that's why I've made this course. Because all you need is repeating logic and framework that shows up enough and that is actually based on things that work. And it just needs to repeat. You guys need to only trade this now. It's the truth. You guys only need to trade this. You will never need another complicated strategy. You will never need another nonsense strategy that just doesn't provide enough. You will never need any of that, guys, because you have absolutely everything. You have all the framework here that you need. Now, I hope you found this episode valuable, and I'll catch you guys in the next one. Thank you as always for watching. Thank you for continuing the support, and I'll see you guys later. What's going on, everyone? Welcome to another installment of the free course. Today we're talking about 930 and when 930 is predictably going to be manipulation or distribution. As you guys know, if you are familiar with ICT concepts or trading in general, you know there is a big volatility injection at 930. Now we can predict this to be manipulation or distribution, and today I'm going to teach you exactly how, so you have no questions on how to know it's going to be distribution or manipulation. Let's get into the charts. As always, on your screen you will see a little depiction. Now we have 930 at the top, and here we have manipulation, we have distribution. So this is an example of manipulation. Now the red flag here, the flag represents 9:30 a.m. Eastern Standard Time. Everything I say and refer to is New York time and New York time only. Now the red flag is 9:30. You can see in this manipulation example, 9:30 runs higher, taking out range highs and probably a previous high back here. Then we get distribution afterwards. And in this example, to be honest, this would usually be 10 a.m., right? So on the right hand side, you have an example of when 9:30 is distribution. You can see here, this is 9:30. This is the distribution lower. Now I have 8:30 marked up with a little light bulb there for a reason, and I'll get into that reason in a second. But first, the easiest way to predict whether 9:30 will be, let me move that real quick, distribution or manipulation is simply, have we done it before 9:30? Okay, done. When I say done it, what do I mean? Have we manipulated before 9:30? Now a valid manipulation needs to be a run above an old high or old low, SMT, and then you have valid manipulation. All right, note that down. Rewind what I just said. That's valid manipulation. So here you can see we've built up liquidity before 9:30. Then 9:30 does what? Runs into this liquidity. Then we get a leg lower, and now we can look for distribution towards 10 a.m. Okay, really, you want to look at 9:45 to about 11 a.m. Okay, so at some point we'll get a leg higher and then distribution lower. That's because 9:30 provided the manipulation, whereas in this example 8:30 provided the manipulation. So when do we expect 8:30 to provide the manipulation? Potentially if there's 8:30 red folder news. Okay, so if we have 8:30 red folder news, you could potentially see 8:30 perform the function that we would usually look for 9:30 to perform. So if we have 8:30 news, really this should be here, right? So we have 8:30 news here, we run higher, performing the manipulation, then we get distribution at 9:30. So why in this example here, on the right hand side, why is 9:30 distribution instead of manipulation where it usually is? That is because 8:30 performed the manipulation. At this point, you'd want, on a lower time frame, SMT at these highs, at this high. Obviously, it's just a line. So in the example, because it's just a line, I can't really depict that we have an SMT there. You'd look for SMT to confirm that that is the high being put in. Then you would look for a little retracement and 9:30 to perform the distribution. That is why sometimes 9:30 just runs away from you. There's times where you load up the charts, you're waiting, okay, 9:30 manipulation. Everyone's told me 9:30 manipulation is all I need, cool. And then you get into a retracement and 9:30 just drops without giving you a chance to get into the markets. Now, the reason for that is because usually when there's 8:30 red folder news, it will perform the manipulation. Now, a scenario where we have 8:30 red folder and it performs distribution instead of manipulation is a separate scenario. So let's pull that over here. And sometimes this can perform distribution instead. So we build up liquidity, right? And at some point we spike higher. 8:30 does this, right? 8:30 drops lower, which is performing distribution. So instead of 8:30 performing the manipulation, in this scenario here, it performed distribution, right? Now we can look for 9:30 to trade higher and manipulate because 8:30 distributed. then we would look for 10 a.m. distribution, right? So to clear this up, 8:30 we'll use as the light bulb, okay? 8:30 is there. That is the 8:30 red folder hitting the market right there. Now we manipulated before and 8:30 dropped us lower. So 8:30 performed this leg down that you see here. If in this scenario 8:30 performs the distribution, you are waiting for 9:30 to perform manipulation. All right? Very simple. Now 9:30 could perform manipulation here. So this could be 9:30, right? Or even this could be 9:30. This is a scenario you see a lot. When we have that 8:30 red folder news and it drops us in the direction of our daily bias, because again, all of this or everything I'm telling you in this course is pointless if you don't have directional bias. You need some form of directional bias to be able to tie everything in together, right? So 8:30 red folder drops us, we get a retracement higher, and then this red flag again is 9:30. So 9:30 spikes us above a short-term high, then we distribute, right? This is able to happen. 9:30 is predictable manipulation because 8:30 distributed. And the very first rule of the market is we do not engage with the market unless there's been manipulation. Now you might be asking, Loz, what do I do if we don't get manipulation? You skip. You don't trade that day, okay? Now, we have to have some form of manipulation to get involved in the market because above this high, what is happening here? People are getting trapped, right? So people are trapped above this high, buyers are trapped above here, then we can distribute our positions lower because we need to be on side when there is the maximum amount of damage caused. When I say that, I don't mean it in a court. I mean, there's the maximum amount of participants in the market because we want to trade against those uninformed participants. So we need manipulation. Now, there's 8:30 red folder, okay? Now, if 8:30 just performs manipulation, it's a lot easier. But 8:30 can distribute, and then 9:30 you'd look for this. Now, there's another scenario I want to speak about, which is 10 a.m. Okay, so 10 a.m. red folder. What do we do when we have a 10 a.m. red folder? And I told you, you're not going to need anything else after this, all right? When we have a 10 a.m. red folder, you are looking for 9:30. You are waiting for 9:30 because we need to see 9:30 manipulate, all right? When you have 10 a.m. red folder, no 8:30, ignore 8:30. Just use it as an opening price the same way you'd use midnight. When we have 10 a.m. red folder, you can see 9:30 manipulate. Okay, so let's say that's 9:30 there, then 10 a.m., right? So 9:30 the flag, and then we'll do this as 10 a.m. distribution, right? So this point here is 10 a.m. 10 a.m. red folder, 9:30 manipulate. This is the most common scenario you'll see with 10 a.m. red folder, right? So this is our scenario. This is the most common version of this scenario, you will see. So there's another variant which we have to consider, which is 9:30 distribution. So again, under this scenario, which is 10 a.m. red folder, I'm going to make this a bit clearer. This is our scenario. We can see 9:30 manipulate, or we can see 10 a.m. manipulate, all right? So there's a scenario where you can see 10 a.m. manipulate price against your bias to trick people into the market only to distribute it lower, okay? So in this scenario, the 10 a.m. manipulation, 9:30 can drop us, right? So this is the pre-market consolidation, then 9:30 hits and it does that, right? In this scenario, you are bearish, by the way, right? So this is 9:30. Red flag is always 9:30, all right? Now, why do you want to see 10 a.m. now manipulate? Because I just mentioned to you that we cannot engage with price unless there's some form of manipulation. In this scenario here, is there any manipulation? No, because we've built up liquidity and we've just dropped price at the market open. Now you're looking for 10 a.m. to perform that manipulation. So where is 10 a.m. here? In this scenario, 10 a.m. instead of being at this high is down here. All right, 10 a.m. is at this low because now we need 10 a.m. to manipulate. Ideally, to be honest, let me remove this because ideally this looks like a short-term high being run. So we could look like this, right? That could be 10 a.m. there, right? This. Now, This is what 10 a.m. looks like when we have 9:30 distribution. So 10 a.m. manipulation, but 9:30 distribution, right? When we have, again, this is under the umbrella of 10 a.m. red folder. Okay, 9:30 distribution here, and then we create a short-term high, 10 a.m. hits, and what you will find a lot of the time is a 5-minute or 15-minute FVG there that 10 a.m. spikes into. Why does it spike higher? Because 9:30 didn't manipulate, 9:30 distributed price in our direction. So now that 10 a.m. red folder that all of this is under the umbrella of can manipulate price higher above a short-term high and into a 5-minute or 15-minute gap. Okay, that is a scenario you'll see often. So when you have 10 a.m. red folder, there's two things that can happen. Well, there's three. Nothing can happen, right, which is rare, but nothing can happen if you don't have daily bias or 4-hour bias. Or scenario one, 9:30 can manipulate as always, 10 a.m. can distribute, as you can see here, consolidation, 9:30 manipulation, leg lower, 10 a.m. distribution with the red folder. Or scenario two, which is less common but does happen a lot, 10 a.m. can manipulate, and then we trade post 10 a.m. So 10:05 to 11-ish, you are looking for the distribution now, because this can happen where we consolidate the same way we consolidated in this market scenario. We consolidate, we drop price lower, 9:30 distributes price. So this is 9:30, it just drops in our direction. Now you be patient. You wait for 10 a.m., you wait for that spike above a short-term high, you wait for a 15-minute or a 5-minute gap, and 10 a.m. spikes into it with red news, then we can catch this leg lower, okay? And it becomes easy at that point. These are all the scenarios you need to consider. 8:30 news, again, can distribute or manipulate. And you got the usual 9:30 with no red news. This can happen where we have manipulation or distribution. So everything ties into, and take screenshots of these. Okay, everything ties into the red folder news we have. Pretty much everything ties into 8:30, 9:30, and 10 a.m. Depending on what red news we have. And if we have no red news, just focus on 9:30. If we have 8:30 red news, I gave you guys the scenario there. What can happen? You could literally change all of this around. Just change it to 8:30 and the same functions. This would be 8:30 instead of 10 a.m. here. This would be 9:30. Instead of 9:30 here, this would be 8:30. This would be 9:30. The same things are fractal. It's just one ties into the other and all of them tie into one. Depending on whether we get manipulation or distribution at these key times, the next one will be manipulation or distribution, depending on which one the previous one was. So after watching this, take notes on it. You will never need to worry about 9:30, missing it again, or catching it. You will catch every single one. What's going on, everyone? Welcome to another installment of the free course. Today we're going to be talking about Mondays, and a lot of people online tell you Mondays are not tradable at all. This is wrong. Mondays are definitely tradable. It just depends on what Friday did and the news on Monday. So again, this is a full course on what you need for trading. So it'd be wrong, for me to not talk about Mondays. Okay, Mondays are tradable 20% of the time, probably. Most of the time I'm skipping Mondays, that is true. But there's specific reasons I'm doing so, and the specific reasons when it's tradable. So let's dive into the charts. And I want to use this example. I gave a video to my one-to-one students earlier speaking about when Mondays are tradable. Now, Mondays are tradable when a few things happen. Friday trades into a key level, and then Monday's candle becomes predictable, and or we have red news. So if Monday's candle is predictable and we don't have red news, it can be tradable depending on what intraday price action does. When we do not have red news, or when we do have red news, even better if it's only predictable. Now, ideally, I want Monday's candle to be predictable plus red news. That's an ideal scenario. But let's use this example here. Now, this is a Wednesday, but the same things apply because time is fractal. So just because this is a Wednesday, it doesn't mean it can't be a Monday, theoretically speaking, right? In practice, this is clearly a Wednesday. But in theory, this can be a Monday, right? Because theory is just theory. if Monday's candle, you look at my screen here, if Monday's candle looks like this, or rather Friday's candle looks like this, Monday's candle becomes predictable, right? And this is a very simple video. It's not hard, but it's very necessary because everyone tells you to skip Mondays when some Mondays are actually really good and you could be missing out on a really good trading day. So a few things. Number one, NFP week. Okay. If we have NFP week, Monday is usually tradable. Okay. Usually Monday on NFP week will be a predictable candle. Okay. Because the intraday price action is going to be really good. Because the NFP at the latter stage of the week, Wednesday and Thursday, sort of act as an Asia range does, but for the weekly candle instead of the daily range. So NFP week, Monday, you want to look for a trade. Again, this doesn't mean you're going to be taking a trade. It means you want to look for one. Secondly, red news on a Monday. And then third, Friday close. Okay. So in this example, this is a Wednesday, right? But again, we're talking theory. So all of this doesn't matter. If Friday's candle, we're pretending this is a Friday. Okay. If Friday trades into a key level, which is this daily fair value gap, 1, 2, 3. There's a gap here and we close like that. Look at the rejection there. If we go to the hourly chart, this is a strong rejection. Okay, remember that's our key level. Where does our theoretical Monday open up? Here, right? So theoretically speaking, this is your Monday. Monday trades lower into a key level, rejects higher. This is when you want to trade Mondays because here we had Friday's close. When Friday's close gives you a strong indication that Monday will be a predictable expansion in one direction, that's when you want to trade Monday. And again, red news. If we have red news on a Monday and the candle's predictable, Monday's tradable. And then obviously NFP week, more of a niche example because NFP is once a month. Usually the first month, or is always the first week of the month. Then you can trade Mondays. And again, if intraday price action aligns, that's when Monday's tradable. So again, just from this short video, this 3-point checklist, you've learned that when these things appear, Monday's tradable. So don't be skipping all Mondays. It's not necessary. Some Mondays are very good. Now this Monday, for example, and this is an actual Monday at the time of recording this, we have a volume imbalance here. Friday's close is up here, right? Now, technically, we are overextended. We're trading at all-time highs, so not really. But Friday here didn't trade into a key level. It just traded into the body of this candle, rejected higher, which is fine for a Friday, but that doesn't mean Monday's candle's predictable. Now, today, I'm skipping this Monday. Why am I skipping this Monday? Because to me, I want to use this information here to frame the weekly candles range, okay? Now, I want to use Monday in this scenario to frame the weekly candle because if Monday closes like this, let's say it's closed right now, then I know we have a volume imbalance below us. We can use Monday's liquidity to frame that weekly candle expansion. Now, let's say tomorrow we trade below this low and into the volume imbalance here. Then Tuesday, I know, and we reject from it. Then Wednesday becomes predictable. Let's say we don't do that. And let's say we today close below here. So this line down here, I'll actually just mark it up so it looks a bit easier. This red dot is where we close today in this hypothetical scenario. We close here. Now, if we close down here, where this red dot is, I know we've disrespected a volume imbalance. So potentially we could see Tuesday do this. Trade into the volume imbalance, and then the rest of the week trade away, depending on intraday price action. But you can see in this scenario, I'm using Monday's price action to frame the weekly candle because, I want to know where this weekly candle is going to trade to. If we disrespect a key level on Monday, then guess what? We're probably going to, at least at the start of the week, trade lower to these lows because these are low resistance liquidity lows. Now, this is where candle closures become very important. And I spoke about this earlier in the course. This is where candle closures become important. And this is using them in context. You don't just want to use candle closures randomly. It's all a story behind price. The story is we're trading higher. Now, if we respect this bullish volume imbalance, the next days become predictably bullish. But it all depends on what we do at this volume imbalance. And that's why Mondays can be a skip or tradable. Very short, straight to the point. You don't want to skip every Mondays. NFP Friday on that week, Mondays are usually very good. But again, it depends on intraday price action, whether you will get an entry or not. So very straight to the point, when or when not to trade Mondays. What's up everyone, welcome to another installment of the free course. Today we're talking about something that no one ever shows or says. Today we're talking about effective journaling. What effective journaling actually looks like. How should you journal, right? This right here is my actual trading journal, all right? All of this are the trades I've taken this month. You can see I've taken 1, 2, 3, 4, 5 wins, 3 losses. That's a good win rate. And it's got me $750,000 in Top Step funding, and I'm currently up $3,000 on each of them. Okay, so do the maths, right? 3 times 5. Okay, now NQ long, NQ short, NQ short, NQ. You'll notice a pattern here. You'll notice a very strong pattern with the assets I'm trading. That's why I tell you guys you only need NQ. All right. Today we're going to be diving into a couple of these, and I'll show you what my journaling looks like. Now, your journaling should probably be more detailed than mine is. All right. My journaling is very basic now because I know exactly what my next trade will look like. Some of you don't know, but by the end of watching this free course, you absolutely should know. All right. I always know what my next trade will look like, and I suspect I may get a trade tomorrow or today. Right? Just based off of my statistics, based off my data. I can predict that because I know when I'm trading and when I'm not. Now, why I say that first? Well, what did I say about NFP? NFP, Monday and Tuesday, usually become tradable. All right? So NFP's Friday, you probably won't see a trade here and here. Actually, you definitely won't see a trade on Thursday. You might see a trade Wednesday. I doubt it. Friday, you might post NFP, always post NFP, but then October kicks in for me. October doesn't start on the 1st for me. It starts after NFP. That's a little gem. Write that down. Not just October, all right? Not just October I'm talking about. I'm talking about every month. It doesn't start until NFP's passed for me, right? And I've learned this over years and years. So learn from my lessons without having to go through it yourself. Anyway. Let's not waste any more time. Let's dive into a couple trades here, right? NQ long, let's do this, and we'll go over this loss here as well. First of all, 2025, September. This is a template that's available on Twitter, I think. I don't want to give the wrong @ so let me not, but I'll find this out and I'll give it to you guys. So I've got the year, month, day of week, because all of this gives me data on percentages. So what's my win rate? Day of week, and again, no one shows this. This is effective journaling, right? NQ, and then I grade it. Grade 1, grade 2, grade 3, and 4. Now, grade 1 is a trade I would take over and over again, and it was a win. Grade 2 is a trade where I lost, but I would take it over and over again. Grade 3 is one where I won, but there was something I didn't really like about it. Grade 4 is I lost, and there's something I really didn't like about it. Okay, so I'm not going to repeat. Go over that, rewatch it. I grade my trades from 1 to 4. I got this off Sam KB. All right, so I'm not going to take this as my own. I got it off Sam, a really good trader, actual trader as well. All right, now I don't have any affiliation with him, but this is something I took from him, and I found it excellent. Right, it's really good. So grade your trades 1 to 4. NQ scalp model, and then I put 10 a.m. reversal as well, and entry time frame, New York, the session, and then result and risk to reward. Now, my notes are really small usually because I know what I'm doing. Predicting the next 4-hour candle, exactly what I taught you. This is a real trade I took on the 4th of September. Predicting the next 4-hour candle, and right now it is the 29th of September. To be bullish, expansion after 6 a.m. traded into an overnight order block, right? So here we go. Daily order block, right? You have a daily order block here, mean threshold of that, got traded into. What did we take down here? A low, another low taken at this point, right? So we go into the next chart, 4-hour, predicting bullish 4-hour candle, right? Which it was, because this is where the recent liquidity is. And if you look, that stop run there is this. So we've got a stop run, we rejected from it, and you have a 4-hour gap, okay?
excuse me. Then you had an order block here. Now, this was 6 a.m.'s candle. So 6 a.m.'s candle did what? It traded down into the order block after we've traded away from this fair value gap and that daily stop run. Now I'm asking myself, where's the smooth liquidity? Where's the smooth drawn liquidity? Up here. These equal highs. Now predicting the bullish 4-hour candle here, because it traded into this gap and this order block, so I'm expecting a scalp to these highs. And that's exactly what we got, okay? Here, take a look. That's that daily swing low. That's the 15-minute chart. 4-hour gap. Midnight opens there. 8:30 opens there. My scalp came when we tapped this fair value gap. So low to high, premium and discount at this point. What did this do? 9:30, manipulated. We then get an entry on the lower time frame. The smooth highs are here. Is this smooth liquidity? Not compared to this. Now, after it gets up here, I don't care what price does, because I'm not bothered that it traded lower. I'm just trying to operate at a certain time, right? And that time came here, right? Here is the 30-point run above the highs, right? 20 to 30 points above old highs when you're bullish is a good place to take profit if you are not yet at a 1 to 3. Now, 15-minute gap, remember that's this 15-minute fair value gap here, low to high. Then we have 1 drive, 2 drive, and again, real quick, look where 9:30 is. This candle here, if I zoom in, this candle is 9:30. It's manipulating price lower. So we now wait for confirmation. Take a look. 1 drive lower, 1, 2, 3. I like to see 3 drives lower into my point of interest. It's not a requirement. It's more of a confluence. Then and I took my entry here. Once we closed above this fair value gap here and this volume imbalance, I took an entry. My stop loss goes below this low because I want to give myself some breathing room, and I took profits 30 points above the highs. Now, came very close to stop loss, did not stop me out, rallied higher, came back down, filled this fair value gap, and then we get a stop run to take profits. All right. This is effective journaling. All right. My stop loss below here didn't get tagged because, again, I want to give myself some breathing room, and this trade worked out. All right. This is, again, effective journaling. Let's go over to this NQ short, right? Scalp based on NFP data lows. Was going to wait for 10 a.m. open low high close, but my risk was really low because of the possibility of a really high risk to reward. On the top step, 150k times 5, and it passed them. Regardless, it was a good decision and the one I would make again, hence the grade 1. Remember, I told you to grade them. Now, if we go into the screenshot, this one less detailed because I'm more aggressive on challenge accounts, and this was to pass the challenge accounts. Take a look. SMT at the highs, NFP lows, data lows are very important. 8:30 lows, right? 9:30 did what? If you take a look at 9:30, it is about there. 9:30 rallied above here. Then we got an SMT. Look at that displacement there. That is the algorithm tipping its hand to you. It broke a low. Now, everyone says 2022 model doesn't work. It doesn't work because they don't trade it with context. It doesn't work because they're trading it as a pattern. It's not a pattern. This is not random. Breaks the low, trades into the gap. I took my entry here, and then I took my exit at the lows. This was like a 1 to 5. Now, usually, every trade's a 1 to 3. But because, again, I'm being more aggressive on these accounts, I passed them quicker, and I saw the opportunity for a massive risk to reward here. I took that. So that's the discretionary part. Now, don't go thinking you can be aggressive on accounts. The thing is, I can afford to buy multiple more of these accounts if I had to. Now, I don't believe I would blow them, to be honest, just based off my, again, data. But this is just building that framework, right? And I can afford to be aggressive because I can afford more challenge accounts. If you cannot afford more challenge accounts, do not be aggressive. Do not be as aggressive as me. All right, and then you have an order block here once we close below the 3 up close candles. Then, obviously, every fair value gap from that point onwards holds. Now, that's one trade there. Another win here. Framing off and here's a gem. Okay, grade 1 again. Notice most of my trades are grade 1 or 2. Framing off the 3-month open low high close, trading the high to close portion. PM session expansion after slowly grinding AM session. 4-hour equal lows to aim for tomorrow, right? So, take a look. 3-month open low high close, creating the high to close portion. There was 20 days left on this 3-month candle at this point. If we get confirmation, I'm looking for that close to, or that high to close portion to be created, because every bullish or every bearish candle has an open, high, low, close. Open, low, high, close. Now this one was really short, but nevertheless, open, low, high, close. Open, low, high, close. Open, no real low down here, to be honest, high, close. But you get the point, right? So based off that logic, if we get some rejection and an SMT, I'm looking for a scalp lower. September opening price is down here, okay? So if we skip forward now, distribution during PM session as AM session was choppy. Asia session, AM session very choppy, so PM session can be distribution. You've got equal lows and you've got a gap inside here. All I'm looking for is that next 4-hour candle. That next candle's the one I'm predicting. Then you have that hourly FEG got inverted, and look at this. 15-minute time frame, 15-minute gap, lining up with the inverted hourly FEG. That's that hourly FEG there. We traded through it, and then look, we redistribute inside of there. Where do I get my entry? During PM session, okay? That's that gap. That's that 15-minute gap there. This is a 15-minute gap. This line and this line, all right? Because AM session was choppy, this isn't moving in any real direction. It's just gone higher, gone lower, chopping around. So PM session can now be distribution. Remember we spoke about session characteristics, okay? And then the entry was the 50-minute gap. We ran the high, 1 drive, 2 drive, 3 drives. Notice that. Distributed lower, FEG here, stop run here. That's when I took my entry. Stop loss went above here. And then I took my exit down here. As we started running into the final hour of trading. Alright? Another great trade. Took a loss here. Grade 4 because I did something wrong. Alright? Grade 4 because I wouldn't take it again. Now, take a look. I was feeling really confident at this time. Alright? And then look what we get. We get weekly opening price here. TGIF is what I'm expecting. Why? Because we've hit a high time frame key level. Now, what I should have done is really waited for this high to be taken, which is why it's a grade 4, because I probably wouldn't take this again, right? And it was a loss. So now 930 manipulated the highs. Now, all of this framework on the lower time frame is fine. This is perfect, right? I don't mind that. But we didn't take this high out with this candle. I would have much preferred that. That's why, again, I graded it 4. Now, all of this logic here is valid. I don't mind this. 930 ran above the highs, manipulating. We had 10 a.m. red folder, so I'm expecting distribution from this gap. I took a sell here, really low risk, because it was Friday, so I don't mind. And then got out above this high. Very simple. But you see how I journal. This is how I journal. All of this, all right? 5-minute entry, grade 4, NQ Scout model, New York AM, right? And all of these look the same. This is exactly how you should be journaling and exactly how you become a profitable trader in the shortest amount of time, all right? I hope you found this video valuable. It's one of the better ones in this course, so really take notes on it.
Hi guys, I hope you are all doing well. Welcome to a post-Monday outlook. I wanted to update just NQ really, not really going over much else. I may look at a few crosses and you can sort of see what my analysis does look like on crosses, but I wanted to go over NQ because I like how it's setting up here. I really do like this. Now, I told you all yesterday I'd like us to seek some form of discount, whether that's a equal lows on the hourly chart or whether that's a 4-hour key level, something like that. It doesn't really matter. Some form of discount before we do go higher. Now, what we have done in here is we have a low and I like how we swept the high and then came right back down. That indicates to me that we probably want to seek, again, some form of discount, the low, and I like these set of down close candles. They also, I think this might be a bit cleaner on this. Okay, never mind. I also like the breaker here. So low, high, lower low, and then we trade above. I did think it would look cleaner without all the gaps, but of course the gaps are still there. Nevertheless, pretend these are just straight body candles. It doesn't matter. This down close candle really should send price higher, especially if we sweep this low into it. Now, consider the possibility that we trade into this fair value gap, because that is even more of a discount. And if you pull up your fib, obviously OTE levels rest down there. So that would be a really interesting level to look for longs from. Now, on the hourly chart, you can refine it even more to this fair value gap. Now, this looks really clean and this looks high probability to me. I'd like us to get down here tomorrow and create some form of Tuesday low of the week scenario where we do this sort of thing, rally, create a range here, sweep a low, and then continue to the high up here, these equal highs, and then the buy side liquidity I've got labeled up there. Now, once we get down here, I'd like to see some form of SMT. So this is NQ, let's say this is NQ, and let's say this line is ES. Right, let me do it over here actually. So let's pretend this is ES. I'd like to see us do this sort of thing, where ES creates an SMT. So NQ, ES. I'd like to see an SMT form inside of this gap. That would confirm to me then that this is probably low of the week. If we get that sort of displacement higher, again, displacement, what does displacement look like? That's displacement. Displacement when we're creating gaps, that's displacement. Notice how we came down, rebalanced, and then ran. Look at the momentum, we even gapped a lot of points. So that is what displacement looks like, and that is what I would be looking at for inside of this price leg higher. Now, an SMT would indicate that we are accumulating. So smart money would be accumulating positions under here. And obviously, if we got the SMT, then it would look like that. So that's the sort of thing I'd be looking for between the averages. Averages being ES, YM, and NQ. Now, PM session may drop us into this, which would be nice. And then I'd instantly start looking for the signatures in price that would tell me the low of the week is in, which I just outlined. So yeah, really that fair value gap is my main interest for now. And again, because it lines up with that breaker, it makes it even more high probability for me. I really like the idea of that. Again, Tuesday would be creating the low of the week, which is perfect. As for DAX, I still want the same thing on DAX, and gold I want to cover now. We're sort of ranging now in gold. We made an attempt to get down below these equal lows and into this, but have came right back up off of that, which if we had to see Tuesday low of the week, I wouldn't have wanted to see this sort of displacement higher. Now, this is not displacement higher to go long. This does not indicate going long. I cannot long with these lows right below us, right? We have low, higher low, higher low, higher low. That's low resistance liquidity. If the lows look like this and we tapped into a key level, then that would be a lot different. That's high resistance liquidity. But low resistance liquidity is a low, higher low, higher low, higher low. All of that, there's no, once we cut through this, there should be no slowing down. That's low resistance liquidity. There should be no slowing down when we have low resistance liquidity. High resistance liquidity requires a lot more slowing down and rebalance, 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 and then drop a bit, rebalance again. That sort of thing is high resistance liquidity. Let me show you here, for example, right? Notice how this low took out all of this liquidity down here and then rallied higher. So when we're selling, well, I wasn't selling this because we're at all-time highs, but in a normal scenario, when we're selling down towards this low and that's your target, you need to consider pullbacks. Look how many pullbacks we have before we get down to that low. All of this in here that's a really pronounced pullback. And then again, pullback, and then it runs through the low. It needed to do that because this is high resistance liquidity. Now, ignore all of this. Let's say this portion of price didn't exist, right? I want you to imagine that blue shaded area did not exist. Let's pretend if you cut there, that was the low and it rallied. If that didn't exist, this move down would be a lot quicker. There'd be a lot less pullbacks. It would be straight down, tiny rebalance, say here, and then drop instantly. It wouldn't lag around a bit, keep going higher, another wick, come just below the low, and then rally higher to give another retracement. It wouldn't look like that. It would be like that, right? That initial move down, that's what it would look like. But because this blue shaded area, does exist,
and we did take out lows, is high resistance liquidity. That is the basics of high resistance versus low resistance liquidity. Now, I do want to make a separate video on that because there's a lot more nuances to it, and there's a lot of stuff you can use to sort of aid your analysis in terms of high resistance and low resistance liquidity. Now, if you take a look here as well, this is a very shallow run above this high. Now, it is higher resistance liquidity now because we did take out that high. If this was a failure swing, it wouldn't be as high resistance, but the bodies of the candle didn't take out that high. Now, I've done this before, and many of you who've been here a while have seen me do this a few times. Often I remove the wicks just to show the sort of high resistance versus low resistance liquidity, because wicks are not all wicks are manipulation, but a lot of manipulation happens through wicks because bodies tell the story. Bodies are narrative. That's where the narrative lies. Okay, the wicks are a lot of noise. Now, wicks can tell you things, and wicks are important. Don't always remove wicks. I'm not saying to remove wicks permanently and never trade with wicks on your chart. They're very important. The liquidity sweeps are still valid, but you have to consider in your analysis whether the bodies took out the lows. So take a look here. This low held. Why? Because we had the bodies close below that low. There's multiple examples of this, and you'll see it a lot. That when we have a liquidity sweep with the bodies of the candles, it's a lot more likely to hold and not give a run lower. So the bodies of the candles, okay, are very important. Now, if we're looking for longs from this area, I like how the bodies here are equally high. I like that. That's a signature in price I look for. Now, the wicks would show, if I pull the wicks back up, the wicks show that we did take out the highs, and that's valid. It's it's more high resistance, but the bodies, if the bodies closed above here, that would be classified in my eyes as a high resistance liquidity run, and that would be that. It may take a lot more pullbacks and a lot more rebalancing to get a run into this high, but because the bodies closed below, I like that. More specifically, I like how the bodies didn't close at that wick. Let's say the bodies closed at this price level here, this line. Say the bodies closed there and declined. That would be more high resistance because the bodies closed above this body. Now, it's a lot of word salad right now, but basically, remove the wicks and look, that's low resistance liquidity because it's a failure swing. Now, down here is also low resistance liquidity. Why? Because this wick lines up with these wicks. They're relatively equal lows. They don't have to be to the point equal. That's what I feel like a lot of people get wrong. Liquidity is not to the point, right? I talk about absorbing liquidity a lot. Liquidity is not to the point. It's not going to go down there by a point and then just move higher. It does sometimes, but a lot of the time it spends a bit of time down there to absorb liquidity. And remember, this is an hourly chart. So a lot of people are sat on a 1 minute chart getting chopped up whilst we're looking for an hourly displacement, right? So this is low resistance, and this should cut through here in PM session, in my opinion. If it doesn't, then I would expect Tuesday 9:30 to act as that manipulation lower. But anyway, we have that, and I'd like to see a run on these lows to then go higher throughout the week. NQ is the highest probability play this week, and I mentioned that in the weekly outlook. I was waiting to see how the market, 1, opened up, and 2, traded after we opened up on Monday. And right now, it's looking like this is going to be the highest probability play. Because if you look at the dollar, now dollar is falling off a cliff right now on the hourly chart. It's given a form of displacement. I'd still rather wait in here because we're still inside this trading range from high to low. Now, a lot of people will be so ready to short this, really ready to short this. But again, I am not favoring shorts here. I am not liking this because these highs are way too clean. If, again, we did this, ran above the high and then started to drop, I could be looking at shorts here. But we did not. We didn't run out any highs, any buy-side liquidity. All of this looks like an original consolidation to me. Now, it could drop here and I would just miss the move, which is perfectly fine by me. You all know by now I'm content with missing moves if it doesn't match my trading model. I do like how bonds are going higher whilst DXY is dropping, so it may actually just drop from here. But again, we didn't. This is too low resistance for me. I don't like how we've left this. That doesn't scream high probability to me, so I'm not going to be long in GU or EU. Now, GU gave a really nice move today because EG is massively bearish inside here and has done so. You can see it's throughout the day it's been dying. We had a drop down O to E from high to low there, drops down, rebalances, drops once more, and now it's coming back higher. So EU will be moving as well. I did want to look at longs later in the week. Everyone wants to short this, by the way. I've seen it on Twitter loads. Everyone wants to short this. I have no clue why. I mean, look at GU, right? These highs that I've been calling from down here are still intact. And clearly they're about to get ran out, probably tomorrow. But again, this just looks like why would you short this? And I wanted to make a quick video just to speak about logic as well and narrative. Why on earth would you go in trying to short this? Because of what? One candle's rejection. That's a rejection to you. That is no rejection to me. What would change that? A close below here, for example, displacement through here and beginning to use it on the other side. Then I would say, okay, we're probably revisiting, reclaiming this and the balanced price range through here. We're probably reclaiming that and reclaiming the rejection block here. But we didn't get that. We got 2 down days, a rally higher, and then another down day. That's not bearish. So everyone you see on Twitter trying to short this, it doesn't make any sense at all. It's nonsensical. Why would you short a market that's been bullish like that? And I'm laughing right now because this is why it's so easy to get caught in the wrong education. It's so easy to get caught in the wrong education from people who don't know what they're doing. I want you guys to start thinking in terms of quarterly performance. Stop thinking week to week, or even worse, day to day. Some of you even think session to session. Did I make 2% this session? Who cares? Did you make money this quarter? Did you end the quarter profitable? Okay, then that's a good trading quarter. That's a good piece of trading. You should stick to that and stick to your trading principles. Now, pound is bullish in here and it's not slowing down. So I don't know why everyone wants to short now. All the weekly outlooks were bearish, or external range liquidity to internal. Forget external range liquidity to internal range liquidity. That only matters at really higher time frame price points. External liquidity, any high with a swing high can technically be external liquidity. I do not view external liquidity as this. I saw people labeling this external liquidity. Let me go on EU actually. People were saying that's external liquidity. Yeah, by technicality, but that's not external to internal, sorry. That's not how we use it. External to internal would be, let me go on the daily chart and I'll show you exactly what external to internal means. So external, actually stay on the weekly. External to internal is a longer term price swing. And then it goes back to internal. So this down here, notice how this is a long-term price swing, because this happened April 2015. Now we're going way back in time, but price never changes, right? This is the algorithm. And then in November, December 16, we take out that external range liquidity. That is external range liquidity because there's nothing next to it for ages. That's external. This in here, or this in here, or this is not external range liquidity. That's external range because this is your range from high to low, right? We're always working within some form of range. So until we take the high or the low of that dealing range, it's not external liquidity. So please stop listening to mentors who do not know what they're talking about. That's not external. That's external. Why? Because we've been stuck in this trading range, August 2015, March 2015. Throughout the year, we're trading inside of the high there and the low here. So when we come down here in December of 2016 and then into January, when it rebalances this, that is external, referring back to internal. Okay? That is when you use internal to external. it's a dealing range. It's not random swing highs and lows. Okay, it's a trading range. So for example, in here, right? This over here is external liquidity. Why? Because we were trading inside that range for how long? Take a look. We were trading inside this high and this low for how long? Well, July 2023, October 2023. When does it exit that range? November 2024. That's when it takes external liquidity. So what does it need to do next? Refer to internal liquidity. Do you see? That is the algorithm. That's how it works. It's not random highs and lows. It's working within a specific dealing range, not random ranges, right? So right now, for example, what are we working within? Well, we've got this low here because this is the last low that took out external liquidity. And what is the overall price swing we're working within? Well, the price swing started up here. So this high to low is the higher time frame dealing range. External liquidity lies at key obvious swing points within its own dealing range. All right, it's not random highs and lows. So I wanted to get that across. And obviously the idea is fractalized. So let me find a fractal example of exactly what I'm talking about. This is on a smaller scale. So this is quite a good example where it didn't do it straight away, but nevertheless, it's an example of external and internal liquidity. Between this high and low, in here, these are all daily candles, right? So between this price swing, this is all working with internal range liquidity until we take a low or high of this range. Then we refer to internal, okay? Do you see how, I hope it's starting to come together now, right? It's not random highs and lows. Then we take out that, where does this price swing originate from? Here. Take a look, right? Price swing originates from where? I'm talking this price swing. Originates from here. We have a range, high to low. Trading inside the range, external liquidity. Then we start to work higher. All of this is internal. We're reaching for internal until we reverse and we reach for external. When do we reverse? At a key time. What do I mean by that? What's a key time over here? The new quarter and the new month. So February here, right? March here. Let me actually use March, right? March the 3rd, new monthly open. We come down, take out this low into a dealing range, low to high. 70% is around there, eyeballing it into an order block and rally. But this quarter, look at the quarterly open here. The quarterly open is where? There. Notice how all of this, after taking out this external low, is working around the open until we sweep a low, displays. At this point, you're looking at this high. Why this high? Well, if we take our quarter again, October the 1st, this is Q4 of 2024, and this is Q1 of 2025, right? This here is the end of Q1. So if I remove the lines from here, the key liquidity lies within quarters on the daily chart. Now that's key, on the daily chart. There's key liquidity on the weekly chart, on the 4-hour chart, on the 1-hour chart, on any time frame, there's key liquidity. The key higher time frame liquidity, the trick to the higher time frame is the quarters. That's the big moves. Is this not a market maker buy model? Almost exactly within 2 quarters. Okay, so the previous quarter highs, we expand throughout Q4 of 2024. We then break structure to the upside when? Okay, now people say market structure's bullshit, market structure's nonsense. It's not. Okay, market structure works when you blend everything together. It's not just a break of market structure on its own. Notice how when we break market structure, in the new quarter, notice how it never comes back below this low. Because it's key time. It's time then price. And this is what I'm trying to get across to you. I was meaning to do this higher time frame teaching for a little minute, and I've just randomly got onto it. But on the higher time frame, it's always time and price. What does time look like on the higher time frame? but it's quarters and months. So if you take the quarter, the old quarter's highs expanded, we then broke market structure, this high, in when? The new quarter. The new quarter that is set to expand. Why? Well, why is it set to expand? Higher time frame, key level. Do you see how it's blending in together? What's the higher time frame key level? The fair value gap back here. Okay? So this quarter came down into a key level. The next quarter is set to expand. Why? Because 1, we broke market structure. 2, it's the new quarter, so a new open, low, high, close. 3, displacement higher. 4, OTE, low, high, OTE. We come off of it. And now we can expect expansion. And do you see how we target the previous quarter's highs? Now, we're in a weird place right now. Why? Because we're clearly overextended on the upside. That does not mean it is just going to stop dead in its tracks. That does not mean you go in and short it. Now, I mentioned this before. We're in a key higher time frame level here. Inverse gap there. We're clearly inside of that. Now, that does not mean you just go in and short the hell out of euro. You have to wait for key times. When could a shift happen? Now, I'm not saying it needs to jump higher and rally into 1.7, 1.8, even 2, 1.2. It doesn't need to do that. But when would a shift here be confirmed? Well, look at our key time. Remember, time on the higher time frame. We are a few candles away from a new month. A few daily candles away from a new month. Would it make sense for us to complete this move down in 2 candles? No. Wait for the new month, because you get a new monthly open, high, low, close. You get a new monthly open in price. And we've had, right, blending quarters now. We've had the quarter. Where did the quarter open up? Don't even know what that is. I've just got this, so I'm still getting used to it. Where did the new quarter open up? Down here. So are we, from an open, low, high, close and open, high, low, close perspective, are we creating the open, low, high, close or the open, high, low, close? Obviously, the open, high, low, close at the minute, right? That quarter opened up there. We've got 2 months on this candle. So this candle could come all the way down here in the next 2 months. And then July, if it did, I would expect July's 3-month candle, the new quarter, to expand lower, targeting this rejection block. But we have to wait. You have to be patient and you have to see, okay, what do we do? Do we get a higher time frame SMT? Are the COT fundamentals telling us, what's the word I'm looking for? The institutions are bearish. Are they net long or net short, right? Is open interest on our side? Is the dollar and the bonds in a higher time frame key level? Okay, are one of those tipping its hand that this wants to be the high? Not this exact high, but this area wants to create a high for the new expansion to occur, right? Because price cannot expand for forever, right? You must understand that. And now we are expanding. We started the expansion in Q1, right? We've expanded and we are continuing the expansion here. Price often does not expand straight for 2 months. And if it does, 2 quarters. If it does, the third quarter will usually give a retracement or a reversal. So you have to be patient, is what I'm saying. If we get an SMT, say between GU and EU starts to displace lower, and EG is going down, and DXY is bullish, and bonds are going down, then you can start to look for sells, and your whole external to internal, right? So keep in mind, guys, this is the quarterly open. Naturally, opens high, right? This may end up being a big wick. In 2 months' time, this may end up being a huge wick, and it will close down here, possibly. Or it continues higher. But until I'm told it may go lower, I'm not shorting it. I am trading with higher time frame order flow. because it is so much more likely that if you get in a buy in euro, it's so much more likely. It's like let me think of an analogy. Like if you're in a boat sailing across and the wind is on your side, it is blowing in the direction of where you want to go. It is so much more likely that the wind just takes you in the direction of this, right? So it's like going with the wind. It's like sailing with the wind rather than against the wind. It's so much more likely that the wind will just take you to the highs because we're in bullish order flow. This is like wind, okay? When the wind changes, then you can start to consider going the other way or redirecting your path if we're sticking with the analogy. But you guys must understand quarterly opens and new month opens. They're very key. What do we have this Friday? NFP, right? Now, if I actually went and found the NFPs all throughout here, you would see a lot of the time that NFP or CPI, that's probably CPI or NFP usually sort of tips its hand to you for the monthly or the quarterly moves, right? So let's find an NFP candle in here that I can use for an example. I'm assuming one of these is NFP, the first Friday of the new month, right? Let me take a look here. Well, Wednesday, the 6th of November, I would assume that is CPI, right? I would very well assume that is CPI right there. Look how it traded down, up, into this for value gap, and then CPI tipped its hand. Look what we did for the rest of the quarter. Down, right? I'm sure there's also a high impact here, probably CPI again. What do? Retrace and then trade higher. Now again, be patient. Let that NFP sort of tip its hand to you. The big quarterly moves you're all looking for and the big monthly moves you're all looking for all happen after NFP. They don't happen before NFP. NFP is tipping its hand to you. Okay? Now this was originally going to be a tiny little video on NQ, and I've turned it into a higher time frame teaching for 30 minutes. But why slow down now? I'm spilling it all today, clearly. Now, we look at the bonds, right? So we have to blend all the higher time frame teachings together. Take a look at the bond. Let's look at the bond 3-month chart. Is this really going anywhere? No, it's not really going anywhere. What we are doing is we've swept that low there and we are simply consolidating now. Why? Because price is absorbing liquidity. It's not just touching the low and it's gone. It's going back up. That's it. That's not what price does. Price absorbs liquidity. Sometimes for months on end. 2023, for a whole year, we've been absorbing liquidity. Now, you must understand, this is just time. The algorithm doesn't care, doesn't give a shit about time. It just has to print candles because this is what we're looking at. This is a representation of time. Not every candle is important in here. It has to be printed because we're looking at a time-based chart. Not every candle is important though. And that's what I want you guys to understand. Now, take a look here. If we mark up our quarters again, because the higher time frame doesn't move without quarters. Quarters are the key opening times. The same way I tell you all, and every student comes to me, what's the key opening price for the day? Midnight New York. The same way you'd look for a Judas swing in London, you look for it in a quarter. It doesn't change. The concepts don't change. Time just changes. So that might take, 3 hours in London? Whereas here it can take months. Okay, the quarters are no different. Where did this quarter open up? Take a look what we've done here. Now this could very well go down. It's bullish right now. Take a look at, this is a key level. It's also a key level at the quarterly opening. Quarterly opened up here. So we are seeking the quarterly opening price. This is the key time. That price right there. 117.27. Notice how there's a key fair value gap there. What you could expect is this in the new month, right? Bang, hit that level, start to work lower. What do we target? Previous month low and what? Previous quarter low. So, am I saying the top is in on Euro USD? No. Not right here, not at this price level, not at 1.14139. It's not in. The top is not in there. But if bonds get up to this level, show SMT. Let's say the 30-year does that. Let's say this is the 10-year and it does this. Right? But obviously down here. Let's say the 10-year does that. This is the 30-year. And we displace away and we're disrespecting down close candles and respecting up close candles. Then I can say, okay, what's dollar doing? Dollar is going higher, okay? Dollar's swept this low now, opened up down here, gave some low, and started to retrace higher. Okay, is it likely we go for this? Is it likely we go for this? Is it likely this wants to get rebalanced? Possibly. What if bonds don't get there? What if bonds cut through this level? Okay, then what is it likely we aim for? Do we not have equal highs here? Do we not have this gap? So when we hit that level is when we consider what we are going to do. You can have a bias and you can have a preference. For example, my preference would be we hit this level and do this, the scenario that's on your screen. But if we don't hit that level, or let's say we cut through that level, consider this high. And then once we take out that high, you have to consider that we might go lower. But again, I'm looking for the next weekly candle print. I'm not looking for the next 7 weeks. I'm not predicting the next 7 weeks. I'm predicting the next candle. That's it. So if we get through here and we reaccumulate, and how likely is it that we go for the high? Very likely now. Why? Well, we're above opening price. We disrespected the hell out of it. We disrespected a key level and we traded up to the high now. Now you can consider longing this again, GU. Because just because we take out this high, it's not done. Doesn't mean it's done on the upside. Is this not low resistance liquidity? But it's from 2021, you might say. Doesn't matter. It's just time. It's just time. The candles are the same. If this was an hourly chart, what would you say? If this was an hourly chart and you were looking at this and this was an hourly chart, you'd say original consolidation, right? You'd say this is a buy model. So why is it different on the weekly chart? Why does everyone act like it's different on the weekly chart? It's just more time in between. That's all it is, time. Okay, so if this was a 15-minute chart, everyone would be saying, oh, that was a clean long in there. I'd hold to the original consolidation. But because it's a weekly chart, no one wants to say that. And everyone's scared that it might flip above this high, which it might. But we'll find out after NFP, after these key events, after the new month opening, after SMT and displacement, which is grouped into what? Institutional sponsorship, right? But anyway, that was a huge rant, and I think I've pretty much covered everything I want to cover. So yeah, basically just wait for this new month. There's no rush in here. You don't have to rush in. You don't have to call a top. It's not what we do. I am bullish until proven otherwise. I am also not touching this. Why? Dollar's still in a range. Dollar's not doing anything. I want to catch these moves. Quarterly moves. Right? Do you see quarterly open? Where is that? Here. Open. High. Low. Close. Like magic. Right? Like magic. So, I am not bullish dollar yet. I may be bullish dollar at some point, but not just yet. Okay, you have to be patient inside these levels. Now, that is a lot to digest, but really focus on these monthly and quarterly opens. The quarterly opens are so powerful. No one talks about them. I have no idea why. I couldn't tell you why, but they are so powerful and no one talks about them. It's the same concept. Everything is open, high, low, close, and open, low, high, close. Okay? Everything. Now, bonds are ripping higher here. I want to wait for us to get into this key level. Now, dollar shorts may happen. I would have really preferred us to clear out that liquidity before looking for shorts. If I gun to my head, I would say it's probably going down here to at least this imbalance. Trade through that imbalance, you could look to redistribute on the other side for this low resistance liquidity run down here. But we have to consider these highs and how that makes it lower probability. Okay, and that is all we are considering. Why would you not just trade this? I mean, how much cleaner does this look? Looks so much cleaner, looks so much more obvious, right? And it's so much more of a discount. There's no lows here. There's no lows here that we don't want to see taken. There's none of that like there is on dollar. There's a whole consolidation here that I don't like the look of. That I do, it looks like a trend line. So many stops are here. Do you think everyone's just going to win? And if they do win, they won't win next time. Okay? My point is, everyone will be stopped out below here. Everyone will be stopped out. Whereas retail are all in this. They're all in it. They're seeing this leg down and they're thinking, yeah, this is shorting. There's no way. With all that resistance, it takes it up there. I would bet it probably does. And if it doesn't, cool. Well, congratulations. Well done if you made money. But this is the mindset you need to adopt. Because at the end of the quarter, like I said at the very start of the video, base your performance of quarterly performance. You think when does the quarter end? July? You think July you're going to care if you miss this drop down? Of course not. Why would that matter? You stuck to your plan. You can't short with highs like that. You're shorting a trend line. What sense does that make? Go on to 15 minutes, even worse. You're shorting a trend line. Look at that. There's literally trend line trading. Resistance, resistance, resistance. Okay? I am happy to sit this out. Because why would I engage with this when NQ looks this clean? Makes no sense at all. But yeah. NQ tomorrow, guys, I'm watching. And look for SMT between the averages, as always. And good luck and good trading.